Given the kneecapping that we are going through from a policy standpoint, that raises the risk of a potential slowdown quite meaningfully.
We see a much more sort of broader-based slowdown.
What we've seen is already a divergence in terms of the consumer.
At worst, the consumer's mixed.
We see a decline in confidence across the board.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Thursday as Liberation Day comes early.
This is the beginning of Liberation Day in America. We're going to charge countries for doing business in our country and taking our jobs, taking our wealth. What we're going to be doing is a 25% tariff on all cars that are not made in the United States.
25% auto tariffs beginning a week today, sending the stocks of GM, Ford and Stellantis lower, and the president is promising there's more to come.
We have a big day, Howard, coming up next week. It's going to be good. That's Liberation Day. That's going to be on the 2nd, and that's going to be reciprocal. And I think people will be impressed. I think people will be pleasantly surprised, but it's going to make our country very rich because we're the piggy bank that everybody steals from.
Europe preparing its response, Japan considering the same, and Canadian Prime Minister Mark Carney is calling it a direct attack on Canadian workers.
This is a direct attack, to be clear, a direct attack on the very workers that I stood in front of. Unifor workers I stood in front of this morning at the Ambassador Bridge. A bridge that is a symbol of the tight ties between our two countries, ties that are in the process of being broken.
So as the tariffs keep accumulating, it's leading to even more negative revisions across Wall Street. Citi saying, quote, today is a good example of why we don't recommend buying the dip in stocks just yet. As we've said repeatedly on this program, the golden age of volatility continues.
Just yesterday, we were still talking about the idea that President Trump and his whole administration was taking a softer approach to trade and that maybe some of these tariffs would be lower than we expected. And then 25% tariffs and Trump saying this is permanent 100%, which raises the question, how much has Wall Street baked in that this is not a negotiating tool and that this is actually what will get implemented on April 3rd?
The policy volatility is off the charts. This is hard to read. We've said a million times it's fluid. Just a snapshot in time of where they are right now. And this can change again in a day, in 2 days. It can change all over again next week. But I think the underlying trend is pretty clear now. Tariffs keep accumulating over the last several weeks, the last 2 months. And with that, we've got to embrace the same question repeatedly. Are we more concerned about downside risk to growth in the short term or upside risk to inflation?
Right now, pretty much the consensus across the board is downside risk to growth, especially given that the uncertainty is weighing on deal activity as well as capital investment. There might be a short-term pop. Longer term, people are more concerned about what this does to the potential of the U.S. economy. I will say that the volatility in policy headlines themselves is getting attention in terms of how much that itself dampens growth. And Neil Kashkari of the Minneapolis Federal Reserve came out yesterday and said that the uncertainty around tariffs itself, not just even tariffs, could be a bigger effect than the tariffs themselves. And that is what we're seeing, particularly in some of the consumer confidence surveys.
A week ago this morning, Thursday last week, we woke up talking about Chairman Powell. A dovish Chairman Powell and him using the word transitory. I'm pleased you brought up the Fed officials. We've heard from at least 3 in the last 48 hours pouring freezing cold water over the T word with regards to tariffs and their effect on inflation.
In particular, St. Louis Fed President Alberto Mussolem, who all but came out and said, I don't buy transitory. He said, I would be wary of assuming that the impact of tariff increases on inflation will be entirely temporary or that a full look-through strategy will necessarily be appropriate. This raises a question. How much is this market depending on a Fed put that isn't there? How much is this market depending that the Fed will look through any kind of temporary blip up in inflation and address slower growth at a time when an increasing number of Fed members are saying, we're not on board with that?
So far at the index level, we're doing OK on the S&P 500, following yesterday's losses, just about positive by 0.1% to 0.2%. Coming up this hour, we'll catch up with Monica DiCenso of JPMorgan Private Bank, staying cautiously optimistic, Darwei Kung of DWS Group on a confused commodity market, and Dan Ives of Wedbush as stocks in the auto sector to continue to roll over. We begin with our top story. President Donald Trump announcing a 25% tariff on auto imports and floating additional levies on the EU and Canada. Bloomberg's Tyler Kendall joins us now from the White House to get up to speed. Tyler, where do you begin?
John, there's a lot of different places. We should say that these 25% auto tariffs will apply to those fully assembled vehicles, and then down the line, key auto parts, think engines and transmissions. Importantly, President Trump says that his intent is for these tariffs to be permanent and that he has no plans as of now to negotiate any sort of exceptions. They'll also be stacked on top of existing levies. He said he was in touch with the big three automakers, and he told them they have to move their productions as well as their parts divisions to the U.S. if they want any sort of relief. Importantly, as you well know, North American automakers could be hit particularly hard here, considering how highly integrated their supply chains are across the borders, and that it could take years to build new factory plants in the U.S. President Trump did appear to address those concerns, saying that his feel is that these car makers are just going to have to use their existing factories for now. It is interesting, if you read the executive order closely, it does say that for USMCA compliant vehicles, the quote 25% tariff will only apply to the value of their non-U.S. content. So they are going to consider USMCA compliant vehicles in that way. They are going to separate out that non-U.S. content. It also goes on to say that as of now, USMCA compliant parts will have no tariff on them until the U.S. can develop a process to identify what is U.S. content and what is non-U.S. content within them. John, so a lot of moving parts here, if you will, but of course, as you know, big impacts coming down the pipe. The U.S. imports last year of autos and light trucks totaled more than $240 billion.
Tyler Kendall with the latest down in Washington, D.C. Tyler, with more to come throughout this morning. Staying on top of the markets, the auto sector is firmly lower around the world, including stocks of GM, Ford and Stellantis. The broader equity market is still doing OK at the index level, up by 0.2% on the S&P 500. Here's the take from Monica DiCenso of JPMorgan Private Bank, writing, "We've been constructive on risk assets the last couple of years, and we remain cautiously optimistic. We believe the volatility, though, is back. Trade policy remains rightly the primary source of investor uncertainty." Monica joins us now for more. Monica, good morning.
Good morning.
How do you respond to the latest announcement?
It's very frustrating. It's very hard in my seat to try to predict what's going to happen, and that's what my job is, help people figure out the future and how to invest around that. And you just hear all this noise and just doesn't feel like Liberation Day is going to be Clarity Day. And so I think a week from now, we're still going to have a lot of questions. There will still be uncertainty. There will still be volatility. And so the most important thing for many people I work with is just diversify, have a plan, and get ready for more bumps.
You still see a path, though, for the S&P 500 to go to 6450 by the end of the year, that still is your base case at the high end of that range.
It is predicated on earnings growth, and this is the challenge. Like, what does this do to corporate spending, behavior, consumer behavior? We don't know yet. We had a really strong last quarter earnings. We'll see in a few weeks as we start to get through earnings again if this continues.
What do you make of Neel Kashkari's point that the uncertainty and the hit to consumer sentiment that we're seeing around the sort of on and off tariff announcements itself will be potentially more punitive to growth than even the tariffs themselves? At what point do you say, okay, this has gone on long enough that you can't make it up by providing some clarity on Liberation Day postponed?
Yeah, I think the next few weeks are going to be critical, because if we don't get any sort of calming around these headlines, I do think you start to worry about this seeping more permanently into consumer psyche, investor psyche. Right now, investors are saying, this might just be a negotiating tactic. It's noise. It's not going to. It's transitory, to use that tricky word. But the longer this goes on, the more I agree with him that this will have a permanent impact on people. Most clients I work with are still saying, I can deal with this. Let's just wait out the next few weeks, and then I'll move, and then I'll decide what to do.
Just to add to Lisa's line of questioning, are we putting too much faith in the Fed's ability to respond to downside risk to growth with a potential inflationary spillover?
At this point, we still believe the Fed put is there. But again, there's just so many moving pieces. And I need to see, the most important thing for me on the equity call is how do earnings look. The other question then becomes one of valuation. Because with this much uncertainty, is anyone willing to pay 20 times for U.S. earnings?
How much
and I think that's the concern. It could be 18 or 17, and then suddenly you're down 15%.
Well, just pick up on that, the valuation point. How much of this story have we already discounted in the U.S.?
I think we've discounted what we see right now, which is the chaos, right? So you've had valuations come in. But again, if this is more persistent, if this continues into the summer, then I think there's a real question about, is 20 times the right number? And that's what our valuation is predicated on, that kind of multiple. You have to start questioning that if we're still grappling with these kind of headlines come May and June.
At the end of last year, people were questioning valuations on a bond yield basis, saying if bond yields continue to remain sticky or go higher, then it starts to raise the risk reward in going from bonds to stocks. At this point, what you're seeing is that bonds on a day like yesterday actually lost value. Yields rose. And it goes to the question of toggling between inflation and growth. At what point does that become a hampering factor to valuations as well?
I think it is. I think that's sort of what you're already starting to see. And the big risk, again, outside of earnings is one of growth. And we are trying to put pencils around what does this look like from a tariff standpoint? How does that impact growth? And in a year when we're talking about kind of 2% real GDP growth, this could be significant if these are permanent, if they are broader, if you see retaliations from counterparts around the world. And that's what's a little bit scary, because 2% growth is one thing, 1% is very different. And then again, what does that spillover do to earnings and everything else?
At that point, what does diversification mean?
For years, equities were the game in town, right? It was all growth, rates were low, you had the AI tailwind. And by the way, that still exists. But the challenge then becomes people are probably still too far over their skis in broad risk assets, probably too focused on the US. I still have a lot of people who have too much probably private exposure. There haven't been a lot of exits. And so I'm seeing a lot of risk in one bucket. We've been really advocating move into some safer parts, move into fixed income. I continue to get a ton of calls on gold. Gold was up 28% last year. People still want to buy more because they're saying, how do I diversify outside the US? How do I have something that's a buffer in my portfolio? And lastly, hedge funds, looking for uncorrelated returns. I couldn't get anyone to talk about hedge funds for years. Now they want to talk about hedge funds again. So it's what's interesting. So what's old is new. This playbook became very boring for a while. Now you have all the tools again to play.
Yeah, and you've seen some spillover to places like Europe, even China as well. Equity markets there have started to pick up. Do you think maybe we're whistling past the graveyard in places like Europe?
Just saying Europe is cheap is a dangerous game, but there are certainly pockets where I think there's opportunity. And so even in the US, this has become a stock picker's market. So I would argue the same thing in Europe. We still are constructive on Japan. There's still, a valuation story there. You have reforms still continuing. So I think you should be looking more outside of the US. Again, most of my clients are still heavily weighted to the US from an equity perspective. Also on the fixed income side, we're looking at EM credit to try to, again, get diversification outside of US dollar.
Lisa, European equities down today. We're down 0.5% on the DAX, but that's where the outperformance has been over the previous few months.
Yeah, but to your point, the reason why the DAX is down is in part because German auto manufacturers are going to be very hard hit by some of these 25% tariffs. And they're going to have to really shift some of their supply chains, considering how much of their business is done in the United States. Have we fully priced the hit to the rest of the world from tariffs implemented in the United States?
This is the argument that Michael Hunt of Bank of America made on Friday going into the weekend, that the sell-off that we've seen in US equities was more about DeepSeek and Doge than it was about tariffs. That for him and many others too, we haven't seen the tariff trade really realized just yet.
And we don't really have a full understanding of what the tariff trade really means, because it's got a lot of hair on it right now with the uncertainty as well as some of the tit for tat and what negotiations there are. I remember when this week was supposed to be negotiation week and suddenly now is something else.
It was. The Europeans were here. The Mexicans were here.
I know.
People were hopeful, and here we are. Monica, it's good to see you. Thanks for dropping by. Monica DiCenso there of JPMorgan Private Bank, trying to make sense of this situation. Equity futures right now in the S&P just about positive. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Let's cross over to Danny Berger. Hey, Danny.
Hey, John. Just to go over the tariff announcements that we have seen in the past 24 hours, President Donald Trump signed a proclamation to implement a 25% tariff on auto imports. Collections on those levies begin April 3rd. The tariffs are expected to raise prices of foreign-made cars, but U.S.-made ones may still see price increases if supplies and parts are also hit by levies. President Trump also suggested that more tariffs would be imposed on the EU and Canada if they work together to, quote, do economic harm to the U.S. In a post on Truth Social, the president said that large-scale tariffs, far larger than currently planned, would be implemented in that scenario. Now, when it comes to Chinese tariffs, President Trump also said that he would consider lowering them if Beijing supports the sale of TikTok's U.S. operation to an American company. Trump expects to be able to secure at least the outline of a deal by next week. He said if an agreement was not completed, he would move to extend the deadline for a sale. And that's your brief, John.
Hey, Danny, thank you. I think it's fair to say the lines are being increasingly blurred by the objectives that seem to swing from one day to the next.
That's a diplomatic way of putting it. What are tariffs for? I mean, you could get to this point of how are they being used as a tool, and who are the friends and who are the foes and who are going to be the main recipients of all of these tariffs? Blurred is a good word.
For negotiation acquisitions, sometimes, apparently. Equity futures on the S&P positive here by 0.1%. Up next on the program, ramping up the pressure of U.S. allies.
This is the beginning of Liberation Day in America. They've taken so much out of our country, friend and foe, and frankly, friend has been oftentimes much worse than foe.
That conversation up next with Don Schneider of Piper Sandler, live from New York City this morning. Good morning. So here's the state of play. Equities just about positive on the S&P 500 by 0.1%. The Nasdaq just about unchanged. The damage was done yesterday. The damage this morning going right the way through the auto sector worldwide. Check out GM, Ford and Stellantis down across the board. GM down 6% in early trading. What aren't you getting in the bond market? Just not getting a bid. Didn't happen yesterday, not happening this morning. Yields are higher at the long end of the curve. What's the signal here? 10-year bond yields up 4 basis points. 30-year bond yields up close to 5.
The signal is that bonds aren't acting as a buffer at a time when the main concern is tariffs that could potentially increase inflation but also decrease growth. Bonds are not the haven. There also is a budget overhang that's ongoing, but that is going to ultimately really challenge how much the Fed can come in and rescue a market that isn't sure what to do with this kind of backdrop.
That's the real fear. The next stop is going to be the data later, 8:30 Eastern time. We get U.S. jobless claims. Under surveillance this morning, ramping up the pressure on U.S. allies.
This is the beginning of Liberation Day in America. We're going to take back just some of the money that has been taken from us. We're going to charge countries for doing business in our country and taking our jobs, taking our wealth. They've taken so much out of our country, friend and foe, and frankly, friend has been oftentimes much worse than foe.
So here's the latest this morning. President Donald Trump following up his 25% tariff announcement on auto imports with a threat to the European Union and Canada too. In a post on Truth Social, the president vowing to slap them with far larger tariffs if they work together to do harm to the United States. Don Schneider of Piper Sandler writing, the announcement of the 25% tariff on autos today shows Trump is eager to get on with the broader trade agenda. Auto tariffs are a core part of the industrial policy and revenue agenda. Much more to come. Don joins us now for more. Don, how much more to come over the next week or so?
I think a meaningful amount is coming, even if it's not over the next week. I mean, what we've seen so far is about 0.5% of GDP in tariff revenue that's been announced. We have now the highest effective tariff rate since the 1940s. When you add up the 20% tariffs on China, 25% on steel and aluminum and derivative products, 25% on autos, and then reciprocal tariffs are forthcoming. I think we've heard those are going to be dialed back considerably. But it's important to keep in mind that we have all of the product-specific tariffs that are still coming, whether it ranges from pharmaceuticals, semiconductors, copper, lumber. So there's much more to come.
Don, we've seen this movie before, only a month ago. Auto tariffs, Canada, Mexico, and then we found out they were exempt under USMCA. And I was watching that news conference yesterday, desperately waiting for a journalist to ask the question. The question never came. Have we got a decent understanding of whether those auto exports from those countries to the United States are exempt under USMCA?
It sounds like a portion of them will be the value added that's attributable to U.S. Production. If it's still coming from Canada, Mexico, will be exempt. It takes time to implement that. My sense is, or at least I group things into kind of 4 different buckets. China is its own trade war. Canada and Mexico is another. Product-specific tariffs is another. And then finally, reciprocal tariffs. I think in the case of Canada and Mexico, Trump's end goal, I think, is to rewrite the USMCA on much more favorable terms to the U.S. And he's in particular fixated on auto production. So, just like what happened previously, you had 25% tariffs on Canada and Mexico that then said, well, it's only going to be 25% on non-USMCA compliant goods. Maybe that ends up being something like 30% of all goods end up being tariffed under those rates, I think that's still, a bargaining chip going forward that eventually those can either roll off and be replaced by reciprocal tariffs or by a rewrite of USMCA.
Don, do you think there's still room for negotiation, given that President Trump said yesterday about the tariffs on autos in particular, this is permanent 100%?
I think, there's two objectives. One is use tariffs to achieve non-trade concessions, and they can range, a lot of different things. You see from fentanyl, illegal immigration, whether it's digital service taxes, even the acquisition of TikTok. But then the other is true revenue and industrial policy. And I think anytime Trump is threatening tariffs on a product, there really isn't much negotiation to be had. He's saying, clearly, this is a critical industry. We can't be reliant on other sport. We have to make it in the U.S. So I think in the case of product tariffs, there aren't really going to be any exemptions, or there's no real negotiations either.
I'm glad you went there, Don. Yesterday, there was also this from President Trump. I view it as reducing taxes and also reducing debt, talking about the tariffs and the revenue from them. Within a fairly short period of time, I think we're going to have a balance sheet that's going to be outstanding. From a practical point of view, Don, how much could revenue from tariffs head toward offsetting the deficit that is set to potentially climb by $3 trillion over the next decade?
Here's how I think about it. Last year, we had a 6.5% of GDP deficit. 6.4 of that is our primary deficit, excluding interest costs. The interest costs are 3.1%. If all we did was extend the 2017 tax cuts, by the end of Trump's term, we'd have that 7.5% of GDP deficit. So there's structural upward pressure on spending from entitlements while revenues stay flat as a share of GDP and interest costs continue to grow. What he's announced so far is basically 0.5% of GDP in tariffs that may go up to maybe 70 basis points, maybe higher. That will subtract for growth, basically 1 for 1. So you will reduce economic growth. His tax and economic package, which will include spending increases on defense, border security, spending cuts on things like Medicaid, and then tax cuts, I think leaves us with roughly a 6.5% of GDP deficit, and then tariffs give us a little downside from there. So we're kind of getting pulled maybe closer to 6% if there's not that big of a growth hit. So I don't think this fundamentally changes the trajectory of the deficit. We're going to muddle along in this kind of 6% of GDP deficit, area for the next couple of years.
Does it give more breathing room, Don, to some of the Republican representatives who've been pushing back against some of the proposals and some of the debt ceiling extension and raising the debt ceiling on concerns about an expanding deficit? I mean, can they point to some of the revenue that was being raised by tariffs as an offset to justify their vote?
I don't think so. I mean, of course you could. I think the people who are most concerned about the deficit, say Freedom Caucus members, what they're really concerned about is spending. They want spending cuts, and they're not necessarily going to be placated by tariff revenues. Or likewise, consider Rand Paul in the Senate, libertarian. He doesn't want to vote for a debt limit increase, et cetera, and he doesn't like tariffs. So I think for the members that it really is important to help, who are most concerned about the deficit, tariff revenue doesn't really help. And I'd say secondarily, if we are using tariffs as a tool to bring, onshoring and production back to the U.S., generating a lot of revenue from that would be suggestive of us not onshoring that production and continuing to buy it from overseas. So if they truly do work, they wouldn't generate a lot of revenue.
Hey, Don, appreciate the update. And your reaction to the announcement yesterday afternoon. Don Schneider there of Piper Sandler. I think the number thrown out yesterday was 100 billion, right? 100 billion it could raise. A lot of guesswork goes into that number.
Yeah, if you take a look at Bloomberg Economics, they came out with an estimate that that U.S. imports of full vehicles was about $217 billion worth of cars coming from Mexico, Japan, Korea, things like that. The potentially $90 billion worth of auto parts. To Don's point, this revenue would only be in place if the end objective was not realized of actually bringing production back to the United States, because it means that all of those products are still being imported into the United States.
You'd have to imagine there's a real risk now of some of these domestic producers putting up their prices as well. And that's going to have a ripple effect for the second-hand market too, and that has a ripple effect on inflation, as we know.
Which is a reason why people are grappling with which is the bigger evil, potentially down the line and in the near term, inflation or slowing growth.
The index is doing okay in the face of this. We're just about positive by 0.1%. Up next on the programme, Darwei Kung of DWS Group on a confused commodity market. From New York, this is Bloomberg. Three-day winning streak colliding with a day of losses in yesterday's session. This morning so far, just about unchanged on the S&P. We're positive by almost 0.1%. We're going nowhere on the Nasdaq. Beneath the index level, there's a lot to talk about. Let's get to your morning movers with Danny Berger. Hey, Danny.
Hey, John. Yeah, calm on the surface, tumultuous underneath. I have a look at the three big automakers in America to see the impact that they're seeing pre-market of 25% tariffs on cars not assembled, not made in the U.S. Stellantis down 1 1/3%. Important to put context on this. It fell 3.5% yesterday. So that just adds on to that negativity. Jeffries, by the way, pointing out what's important to note for who's impacted is who has final assembly in the U.S. It points out that Ford, 80% of their vehicles are assembled in the U.S. that are sold in the U.S. So Ford may be having less of an impact. It is still down, though, 3% in the pre-market trade. Now, the 80% figure of assembled in the U.S., that drops to 50% for the likes of GM. And that's perhaps why GM pre-market is the worst performing stock on the S&P 500. That, John, down 6.5% so far.
Brutal stuff, Danny. Thank you. Appreciate the update. More from Danny in the next hour. If you are just joining us, welcome to the program. On our radar this morning, our top story. President Donald Trump unveiling 25% tariffs on auto imports set to take effect 1 week from today. Trump saying the tariffs are, quote, permanent. And Lisa, he's not interested in negotiating any exceptions.
Which really kind of flies in the face of what a lot of people are expecting. Dan Ives is going to be on later of Wedbush, and he still believes this is a negotiating tactic, as many people do, despite some of the rhetoric. When you take a look at the numbers, Bloomberg Economics put it out. Right now, you're talking about $217 billion worth of car imports. You're also talking about some $90 billion of car parts that would be eligible come May 3rd. We're talking about engines and things that are kind of key to the assembling of the car. What is the ultimate goal? Is it to bring production back to the United States? Is it to bring revenue to the United States? Or yes? And ultimately, this is something that people are grappling with to understand what the impulse will be to growth and to inflation.
Can I go with yes? It's the only answer, right?
Sure, see.
I think the answer changes every single day at the moment. This is the problem trying to read this situation. So when we came into work on Monday morning and we'd had our reporting from our colleagues over the weekend suggesting that this effort would be more targeted, it was certainly reinforced by the president in the days afterwards when he said things like, we'd take a lighter touch. I'm paraphrasing here. He teased a lighter touch going into April 2nd. And then bang, 25% auto tariffs. It's very, very difficult to get a read on this situation. You can get lost in the volatility, but I keep going back to the same point. The underlying trend is the story here. And the underlying trend is tariffs are accumulating. The tariffs on China have stayed on. Some of this can be negotiated. Other parts of it won't be. But ultimately, when all is said and done, by the time you get to the end of each month, tariffs are higher. They're not lower.
And tariffs are going to stick, for the most part, longer term, it seems like. And on the flip side, the sweeteners aren't necessarily going to come quite as quickly as people previously thought. Look, I think that increasingly people are saying that the on-again, off-again, but still on-again kinds of tariff headlines that we've been getting, just that kind of volatility itself has a cost. And increasingly, that's what people are baking into their assumptions.
The president's got some serious energy, and I'm not sure anyone can keep up. So close to 2 a.m. last night, 2 a.m. in Washington, the president floated the possibility of more tariffs on the EU and Canada, writing in a Truth Social post that if they work together against the US, then tariffs, quote, far larger than currently planned, would be placed on them.
Talking about tariffs as both a negotiating tool, a cudgel to get certain concessions, and also potentially just to bring manufacturing back to the U.S. This is the cudgel aspect. Again, it goes to this question of who's going to get hardest hit from these tariffs at a time when essentially people thought of them as a way to divide the U.S. and Chinese economy from one another. All of a sudden, Europe and Canada in the crosshairs. And now this administration is trying to deal with the fact that by pushing away allies, they could get together and combat the U.S. in unison. So he's trying to get ahead of that as well. Look, it is hard to get signal. This was supposed to be a week of reconciliation and kumbaya down in Washington, D.C. At 2 a.m., it didn't seem like that was exactly the mood.
We didn't really get the response from the Europeans or the Canadians. We didn't get the policy response. Why? Because they're all waiting for the same thing. They need to wait for what to respond to. And that comes next week on April 2nd. That's going to be the big one still.
And there still is a sense of they're not sure exactly why some of these tariffs are being put on, which of the three prongs of negotiations they're going to be dealing with. So it's hard to know what kind of concessions they are. And then again, I keep going back to this. If your populace is entrenched against making concessions to a nation, how politically popular will it be for these negotiations to happen?
Speaking of concessions, almost lost in yesterday's news conference, take a listen to this. The president saying he would consider lowering tariffs on China to secure a TikTok deal.
about our country more than anything else with respect to TikTok. And China is going to have to play a role in that, possibly, in the form of an approval, maybe. And I think they'll do that. Maybe I'll give them a little reduction in tariffs or something to get it done.
So now it's about M&A as well. Not just all the other things, it's about mergers and acquisitions.
Yeah, it's about deals. Look, it is so difficult to know how to understand tariffs when they're being used as a substitute of every tool for every problem in the book. When you've got a hammer, everything's a nail, and that seems to be what's going on right now. You're dealing with it when it comes to negotiating deals, mergers and acquisitions, when you're coming to immigration, when you're coming to drug use, when you're coming to potential manufacturing rejiggering. It creates a complication of what the nodes are. I will just raise the extra point here. It was supposed to be that U.S. and China was going to be the biggest divide. Right now, so much of the focus has been on Europe and Canada, and actually it is being used as a sweetener to China, that we can actually forgive some of these as long as we can get this deal done.
Even though those tariffs keep going up.
It's true.
Pretty aggressively
That's true.
At the same time.
So at one point, what are we talking about?
If you're just joining us, welcome to the programme. Waking up to 25% auto tariffs. It's hitting GM, it's hitting Ford, it's hitting Stellantis as well. And the commodity market is not alone in being confused. It's looking desperately for clarity on Washington's trade agenda. The Dallas Fed released its quarterly energy survey, and it's filled with responses blasting the administration, including, quote, "I have never felt more uncertainty about our business in my entire 40-plus year career," and, quote, "our ability to plan operations for any meaningful amount of time in the future has been severely diminished." Darwei Kung of DWS joins us now for more. Darwei, welcome back to the programme. Javier Blas of Bloomberg Opinion put it well on X in the last 24 hours. Javier said, do you think these comments would have come under a Biden administration? It's coming under the Trump administration. Just how confusing are things right now?
Well, good morning, John. It's a pleasure to be here again. Absolutely, the tariff comments have a very large impact on commodity prices. I think copper in particular is a great example of that. If you look at U.S. exchange price versus London metal exchange price, the differential now is close 20%, high teens. And that really reflects the expected tariff impact on copper price, even though that hasn't been imposed yet in U.S. And we have certainly seen the copper price gone up year to date. Copper is one of the best performing part of commodity complex this year, up near 30% year to date. Very significant number.
Darwei, whether it's autos or whether it's copper, there is a goal here. They want to stimulate domestic production. How difficult is it to stimulate domestic production in something like copper? How many years would that take?
Well, it's definitely going to take a long time and multi-year effort. First of all, let's just say that if we were to be able to find mines, sufficient mines to actually replace all foreign imports, that's still going to take a multiple year. Your typical mining projects will take 5 years and above to really realize any production out of the ground. On top of that, it's not just federal regulations in play or licenses. Most of the mining projects in the U.S. are going through slowly, most because of the litigation issues at the state level for various environmental reasons and so on.
Which raises the question, Darwei, if you're not necessarily increasing on the supply side, how much does that increase prices over a longer period of time? We're certainly seeing record high valuations on copper. We've seen even oil prices pop. How much is this a permanent shift higher in commodity prices before some of the infrastructure can get built out to increase production?
Well, that's a great question. So the way we look at prices is we split the difference between, say, U.S. price as a result of tariff or other tax issues versus rest of the world, as well as what we call the flat price, which is the baseline price. We use London Metal Exchange price for that. This year in particular, because of slower supply growth, right now we are looking at about slightly over 1% growth on supply versus the typical 2 to 3% per annum growth in the past few years. And this is really a result of several disruptions and other capital program timing issues for this year. We do anticipate, however, starting in 26, that growth to come back again to be between 2 to 3%. So we just so happen to be at a time where the supply-demand balance is going into deficit, and on top of that, we have the whole tariff issue. The other part of the tariff issue that has really driven up the current prices, that many of the traders in the space and merchants in the space are trying to move the metal onshore before the tariff actually sets in to avoid that tariff hit. And that has created an imbalance in trade flow for copper as well. And that's part of the reason why there's incremental pressure on the supply side for copper recently.
Hey, Darwei, appreciate the update from you and the response. Darwei Kung there of DWS Group. Increasingly disruptive. Darwei's painted a perfect picture, I think, of the amount of disruption we've already seen. But the supply side response that this government would like to see domestically with things like copper, this can take years to happen, even if you identify the deposit, and we have done. We've got a massive deposit in this country that's been tangled up in the courts for a long, long time. I think more than a decade now. It takes a long time to get these things done.
Which is a reason why you have to wonder how much you're going to end up seeing higher prices. And you're already seeing that divide on U.S. exchanges versus the London Metal Exchange. And that divide is something people are anticipating, which is the reason why they're putting copper and gold on ships and trying to get them over before some of the tariffs go on. If the tariffs go on before those copper shipments get to the United States, they've got a big problem on their hands. So this is kind of this interesting kind of rapid fire arbitrage.
The headlines are dramatic. It could be hugely consequential, but at the moment there's not much drama in the equity market at the index level. We're just about unchanged on the S&P. With an update on stories elsewhere, with your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. President Donald Trump's incoming auto tariffs will hit Tesla, says CEO Elon Musk. Musk on X wrote, quote, important to note that Tesla is not unscathed here. The tariff impact on Tesla is still significant. Trump said Musk did not advise on the auto tariffs due to his potential conflict of interest. Trading platform Robinhood is entering the banking business. It will roll out checking and saving accounts later this year. The service will be available to its paying Gold subscribers, offering high interest rates and other benefits. Robinhood is not an FDIC-insured bank, but intends to partner with one to offer customer protection. Elsewhere, staff at the Federal Reserve's Board of Governors must return to the office 5 days a week. Sources telling us that senior officials are due back in early May. The entire board staff is expected back by September. Now, for the Fed's 12 regional reserve banks, they are expected to line with the Washington-based one over time. And that's your brief, John.
Danny, thank you. Appreciate the update. I'll say what I always say when I hear these stories. I thought that was already happening.
I know. I was thinking the same thing. I mean, they have to get back to work. I mean, they've been working, just from home.
Sure, yeah.
I just wonder, does this actually make offices great again? I mean, you're going to actually start to see people, deck out their offices, have their little cubicles.
Wasn't that the hope for Washington, to get people back into the offices?
Well, exactly. So here we are.
Yeah. OK. See how that works out. Up next on the programme, the auto sector slapped with a 25% tariff.
What we're going to be doing is a 25% tariff on all cars that are not made in the United States. If they're made in the United States, there's absolutely no tariff. We start off with a 2.5% base, which is what we were at, and we go to 25%.
Dan Ives of Wedbush joins us next, and he says it could make autos in this country more expensive by as much as $10,000. That conversation up next. We've had US equity downgrades from HSBC and Citi, S&P 500 price target cuts from the likes of RBC's Lori Calvasina, David Costin of Goldman, and now Venu Krishna of Barclays in the last 24 hours. Our base case assumes that earnings take a hit as tariffs contribute to a material slowing in US activity. Venu joining us in the next hour. New price target 5,900, down from 66. The S&P this morning just about unchanged. Under surveillance this morning, the auto sector slapped with a 25% tariff.
What we're going to be doing is a 25% tariff on all cars that are not made in the United States. If they're made in the United States, there's absolutely no tariff. We start off with a 2.5% base, which is what we were at, and we go to 25%. This is going to lead to the construction of a lot of plants, and in this case, auto plants. And you're going to see numbers like you haven't seen.
So here's the latest this morning. President Trump's executive order sending shares of GM, Ford and Stellantis lower this morning. Dan Ives of Wedbush writing, in our view, these initial tariffs, if they hold in their current form, would be a hurricane-like headwind to foreign and many US automakers and ultimately push the average price of cars up 5K to 10K. Dan joins us now for more. Dan, welcome to the programme. Let's just start with the basics from the top. Who's most exposed in the United States?
Well, I mean, Ford, GM, Stellantis, right? I mean, I think part of the problem there is that even if you make it in the U.S., I mean, you're talking a lot of times 40, 50% of parts could be from outside the United States. And I think you have 30,000 parts in a typical vehicle. So I think that's what, when it comes to Detroit, I mean, this is a gut punch to the 313 if this actually holds in this form.
Let's assume it holds. Dan, where does it leave Tesla? Let's do some single name work. What does it mean for them?
Well, even though their cars are built in U.S. in terms of Texas and California, when it comes to parts, I mean, you still have a good amount of parts that come from outside the U.S. And I think that that's what Musk talks about. And in terms of downstream, no one is unexposed when it comes down to this. You have half the cars that have been imported into the U.S. 2024 are imported from outside the U.S. But the ones that are made in U.S., they still, I mean, you have 40% of engines that are basically essentially have parts built from Japan and Korea. And that's why what I could tell you is talking to many in Detroit last night, Europe overnight, I mean, the view is this is almost, I'll say, a non-starter. It would be a backbreaker for the auto industry globally.
What you see right now is some estimates talking about 40% of total operating profits for Hyundai and Kia combined, for example, as one kind of hit that some auto manufacturers would be taking. If this were the final negotiation, if we took President Trump at his word that this is permanent 100%, that there is no room for negotiation, how bearish would you be on the names of auto manufacturers?
Look, I mean, if this held in, and it wasn't in pencil and it was in pen, and it actually got enacted, it would be an Armageddon-like, I think, tariff, for the auto industry. Others could sort of would be less exposed, but Lisa, my whole point is that it would take 3 to 4 years to build a new factory. So the reality is, in terms of this and actually how U.S. car companies make parts, it's just, I view it as untenable. And that's sort of the street reaction. You see more exposed to GM, Ford, a little on Tesla. I think investors are looking at this being like, look, the supply chain basically almost makes this impossible to actually get some of these parts, even from U.S. built parts, because there's no factories.
Which is the reason why I keep going back to this is permanent, 100%, in response to someone asking President Trump, is there room to negotiate? Where is there room to negotiate on the edges based on the rhetoric that you've heard?
Look, and I think that continues to be the uncertainty. I think maybe the overall market reaction is, okay, there still needs to be some sort of negotiation because the reality is that, hey, build it in the U.S., but 50% of parts are from foreign. And sometimes there's parts that you can't even get in the U.S. How do you build a factory? It'll take 3 years. So I think that's part of the devil's in the details here. It sounds great, but I think that's why the reality is, especially when it comes to GM, Ford, Stellantis, I mean, there's so many scenarios that they've sort of been, going through, but the reality is this cannot happen overnight. I mean, it would take years. I mean, in our opinion, it would take 3 years to move 10% of the supply chain fully within the U.S., within the auto industry.
Dan, that word negotiation, let's breathe some life into that. Negotiation between who? There was this interesting moment in the briefing when the president was asked about Tesla and Elon Musk. Had you spoken to him? And the president said, no, I hadn't. That would be a conflict of interest, which begs the question, who's speaking on behalf of Tesla? Who's doing the negotiating? Who's doing the lobbying of the US government?
And remember, there was that letter that Tesla had that was unsigned. And I think that, look, it adds another complexity for Musk and Tesla. Because with everything we talk about with Doge and all the political blowback and the third rail issue and everything we've seen in Tesla, the reality is when it comes to negotiation or at least having sort of, someone that has a say for Tesla, they're actually at a disadvantage because of Musk in this situation. That's the irony of it all.
You've soured on the story, Dan. Still bullish on the name, but soured on the story. What needs to happen over the next month to turn this around for the stock?
I mean, Musk needs to take a step back. I thought last week was a huge step in the right direction in terms of the all-hands meeting. But we've talked about arm's length in terms of when it comes to Doge. You need to balance in terms of being CEO of Tesla and Doge because, you know, it's a moment of truth from Musk and Tesla. And this is a political symbol that Tesla's become. It's a third rail issue. And that continues to be our view. It's about balance. Not him getting out of Doge. There needs to be a balance. But last week was a step in the right direction. Now we need to see more wood to chop ahead next 4 to 6 weeks.
Tesla's a perfect microcosm of a larger point that we've been wondering, which is, can you put this genie back in the bottle? Once you come out with some of these tariffs, are the ramifications in other countries, the retaliations going to get a bit ahead of themselves, get out of control? And I wonder what you're hearing as you travel around the world and talk with CEOs and investors about how much this has permanently affected people's opinion toward certain U.S. companies and their willingness to give the benefit of the doubt to the U.S. tech sector.
Yeah, look, and I think part of the problem is if you're actually looking at supply chain, let's just talk about the reality, right? If you're looking at changes in the supply chain 9, 12, 18 months ahead, you have to start that now. So part of the problem is you can't just start and stop it. So I do think this, and I've seen it, across Asia over the last, call it a month. I saw it in Europe the last 6 weeks. I've seen Detroit. I mean, this is it's caused chaos. But the reality is the enactment of it is almost impossible and it comes down to, if you have no parts in the U.S., how could you now go into the U.S.? It will take 3 years to build a factory. So the average car will go up 10,000, 12,000. Some could be lower, but that's the reality as the consumer.
Hey, Dan, appreciate the update. Dan Ives there of Wedbush on the latest in the auto sector. Tesla in a tough spot. It's down more than 40% at the highs so far this year. Remember the rally of more than 90%? From the election, post-election, post-election lows, a 90% move, 90% plus move to the highs of this year. Just phenomenal rally that's just cratered over the last few months.
And suddenly people care about actual sales again. I mean, there was a time when that didn't really matter. What's interesting is Tesla's actually more immunized than a lot of auto manufacturers to some of these tariffs, at least on the face of it, since they do build a greater proportion of their cars in the United States. That said, as Dan was saying, the larger ramifications, you don't know. We don't have a real clear sense of their supply chain. What kind of retaliation is going to come from this?
Don't know, which is why I don't think we've still fully realised the consequences of it. How can you? We don't know what to do with this. These moves are pretty mild, let's put it that way.
Totally.
They're dramatic headlines. We've said that over the last hour. These aren't dramatic moves that we're seeing in equities.
Which is the reason why Tom Narayan said, how do you average out negative infinity? People just aren't. They're looking through this and saying, this can't be real. What's your counter offer? I keep going back to which countries are going to get most hit by some of these tariffs. Mexico, Japan, Korea, allies. At what point do they start putting up the walls or become more amenable to teaming up together, which is something that President Trump was nodding to? But these are the kinds of counter moves that you have to imagine are on people's minds as they come out, and CEOs have to be the key diplomats.
Equity futures right now in the S&P slightly softer. We're down by not even 0.1%. Up next on the programme, Stuart Kaiser of Citi, Bloomberg's Ollie Crook, Maya MacGuinneas of the Committee for a Responsible Federal Budget, and in the past 24 hours, another downgrade on Wall Street. This time from Venu Krishna of Barclays. Venu joins us in the next hour from New York City. This is Bloomberg.
The uncertainty impact, I think that is probably weighing on growth now more than anything else.
What I think we're in is just a period of policy uncertainty.
We've gone down a route that ultimately no one would have expected 6 months ago.
The next 3 months are really important from a market and economic perspective.
Our economy proved very resilient during a period of rising interest rates, and it's very possible that it'll sail right through all of this political chaos.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The second hour of Bloomberg Surveillance starts right now, so let's kick it off with the scores for you. If you are just waking up and tuning in, welcome to the programme. So the details, the headlines, they're dramatic. 25% auto tariffs for anyone bringing cars into America. The headlines are dramatic. The market fallout isn't. Equity futures so far pretty stable. Equity futures down 1/10%, Nasdaq futures down 2/10. So you want some single names, let's do that. Ford, Stellantis and GM. In the pre-market they look like this. GM's down by 6.6, Ford is down by 3, Stellantis down by 2. If you believe these tariffs were going to stick and stay on, would you expect bigger moves than the ones we've already seen?
Absolutely. This would be a much bigger downdraft, which goes back to the saying that we have said so many times before and heard, is this market taking President Trump seriously, but not literally. That there are going to be increases in tariffs, but they are going to be whatever the market considers reasonable, where sometimes these companies can look through them, work through them, come with carve-outs, and continue doing business as usual. Some of the off-the-envelope type, off-the-cuff, on the edge of the envelope, whatever the expression is, the estimates for what the hits could be are in the ranges of some 20 to 40% of the operating margins of some of these auto manufacturers.
Back of the envelope, right?
Back of the envelope, off the cuff.
Don't worry.
And which are we doing right now?
We're all confused. I don't know what
off the envelope.
We're live? We're live. Okay. Let's get to the day ahead. It looks like this. 8:30, jobless claims. A big question for this market and potentially the wake-up call. Will we get a hit to the hard data? We've seen a hit to the soft data. The survey data's been really weak. Will it bleed into things like the labor market?
Fed Chair Jay Powell has said that so far, these surveys have not translated into a real deterioration into the hard data. You have something similar from other Fed officials. And then you have those who say, actually, there is a problem here, and you have to recognize it, since it does tend to lead hard data by 3 to 6 months. What we're hearing day after day is that right now we could get a recovery if there were great certainty right this minute, or if there were great certainty in a week. But if this drags on for 2 weeks, 3 weeks, 1 month, 2 months, 3 months, all of a sudden the damage from uncertainty is insurmountable and has the greatest ramification almost than any kind of tariff.
Look out for the economic data later on this morning, 8:30 Eastern time for US jobless claims. Equity futures at the moment on the S&P just a little bit lighter, softer down, negative by 1/10%. Coming up over the next 60 minutes or so, we'll catch up with Stuart Kaiser of Citi as stocks snap a 3-day winning streak. MacGuinneas of the Committee for a Responsible Federal Budget, and Venu Krishna of Barclays cutting his S&P 500 price target. We begin this hour with the stocks of GM, Ford and Stellantis lower as President Donald Trump announces 25% tariffs on auto imports.
What we're going to be doing is a 25% tariff on all cars that are not made in the United States. If they're made in the United States, there's absolutely no tariff. We start off with a 2.5% base, which is what we were at, and we go to 25%.
Let's go to Washington and catch up with Bloomberg's Tyler Kendall. Tyler, what's the latest and what comes next?
Yeah, hey, John. Well, President Trump says that these auto tariffs will be permanent. He says he has no plans to negotiate any sort of exceptions here. He says he was in touch with the big three automakers, and he told them that they need to move their production to the U.S. if they want any relief. Now, lobbying groups for the automakers, perhaps unsurprisingly, are sounding the alarm that this could impact consumer prices, even for domestic-made vehicles, considering that these supply chains are so highly integrated across the border that at some point a part is going to end up being tariff. We also mentioned this last hour on the program. It does appear that the U.S. is going to tariff those non-U.S. content parts of USMCA compliant goods. So, John, considered to be a pretty significant escalation, even as we still get mixed messaging from this White House. I wanted to hit some of the other headlines that President Trump did make during this announcement, which is that come April 2nd, all countries will be impacted. Of course, as you know, we had been tracking that Treasury Secretary Scott Bessent said that perhaps the U.S. was going to look at only the top 15% of trading partners that make up the bulk of the trade imbalance with the U.S. But then, John, he went on to say that he plans to be, quote, fair and, quote, nice come April 2nd. He actually said that he thought the markets were going to like what he does and that a lot of people are going to be surprised by their, quote, somewhat conservative approach that they are going to take. We're just going to have to wait and see how this all plays out.
Tyler, do we have any sense of what the negotiations have been like with European and U.S. counterparts in Washington, D.C. amid some of these proclamations?
Right. Well, Lisa, actually, our Bloomberg News reporting indicating that after this week's trade talks with the EU trade chief and some senior administration officials, including Howard Lutnick and USTR Jamieson Greer, that EU officials walked away with the feeling that the U.S. did not want to make any deals ahead of April 2nd. Our reporting also indicating that the EU feels that they will be hit with double-digit tariffs come next week, and that the bloc is going to be tariffed as a whole instead of individual countries. So that sort of does give us some insight into how these negotiations are going, particularly when we do see some trading partners like the EU offer to lower tariff barriers on industrial goods or boost imports of U.S. LNG as some prime examples. So the rhetoric appears to be ramping up from these allies, but at the end of the day, they are really just waiting to see what this final product is going to look like as we head into next week.
Hey, Tyler, they're not alone. Appreciate the update. Tyler Kendall outside the White House this morning. The United Auto Workers putting on social media this post last night: in a victory for auto workers, auto tariffs mark the beginning of the end of NAFTA and the free trade disaster.
There are people who are talking about the positivity of bringing manufacturing back to the United States. You've seen that with unions coming out with statements. Question is now, can they get on top of the idea that this is actually going to be the case? And then going back to what Don Schneider had to say, is this a revenue raiser where you actually keep importing from the outside world, from the outside non-U.S. countries, or are you talking about rebuilding manufacturing here in the United States?
Or a tool to negotiate acquisitions, right? TikTok. A little bit of that as well on the side.
Why not?
It's difficult to get your hands around this. Stuart Kaiser of Citi is attempting to, puts it quite simply. Today is a good example of why we don't recommend buying the dip in stocks just yet. Stuart joins us for more. Stuart, it's good to see you.
Hey, good morning.
What do you make of the last 24 hours?
Yeah, I think, some fingers probably got burnt again. Folks have been trying to engage on the long side a little bit in tech and some of these underperformers. And then yesterday was just sort of a rewind of what we've seen for the last month or so, right? Which was equities lower, tech, momentum, growth stocks all under significant pressure. And then other asset classes largely ignoring it. You didn't see yields move too much. You didn't see gold move too much. So it does seem like equity investors are really trying to figure out what the risk reward around all these headlines is, and it's really causing, a pretty sharp momentum, but also risk off. I mean, the markets are down. It's not just a rotation underneath the surface.
Let's talk about what was down harder, though. What's down harder has been tech. It doesn't feel like the tariff story. It feels like something else. What is it?
Well, I think what you had is you had very high valuation and very extended positioning coming into this. You had these events or catalysts that kind of triggered a de-risking, and the bottom line is you have to sell what you own, and that's kind of what people owned. And I think if you layer on the positioning, the DeepSeek news, and the valuation where it was, you just kind of got kind of a perfect storm or an imperfect storm, I think, depending on how you look at it. I don't think it's some of it is selling of tech, but I think more of it is just we need to take risk down, and that's what we own.
But to John's point, it's hard to know what we've priced in. And I think a lot of people are trying to figure out, have we priced in tariffs at some of the headline levels that we've heard? Or are we pricing in just generally uncertainty and risk off, and only to a small degree? What's your take?
Yeah, look, I think there's probably some baseline level of tariffs priced in, like something that on a blended basis looks like 10% across the board or something like that. The issue with the tariffs, and I'd be surprised if this goes away next week even, is what you've had is very negative headlines. Then some stuff gets walked back, and then the deadline gets pushed out. And to your point, that just adds uncertainty into the system that kind of never gets resolved. What equities want is certainty. Even if it's bad certainty, you kind of want some clarity on this. And really what we've seen is just not that. So it is I would say a baseline price that's probably lower maybe than where Trump wants to go, and a tremendous amount of uncertainty around it.
There's a big debate right now about whether the uncertainty that has been in the markets, in the minds of consumers, that's really impeded consumer confidence, whether it's actually done damage for the longer term, for the end of the year type of S&P price target. Do you think it already has?
I mean, I do, just in the sense that when you look at when the consumer surveys really started to come off, you actually saw that in flows data. So you saw ETF and mutual fund flows pull back. That suggests to me there's kind of a link from uncertainty to confidence to investor sentiment. Can that get resolved over a 6 to 9 month period? Potentially, yes. But the fact is, I think that's what we're most concerned about is not that you've seen not only seen the survey data get weaker, but you've seen that alongside retail investors kind of backing away.
How do you come up then with a model to price in both the uncertainty, the tariffs, the sentiment shifts? How do you understand what parameters to even put on this?
Yeah, it's very, very hard right now because you don't understand exactly what the tariffs are. So first, you don't understand what that does to your growth and inflation. And if you have an earnings model, that all kind of, falls apart. And I think, for that reason, earnings season in a couple of weeks is just going to be extremely, extremely important. These companies kind of have three options. If your stock is down a bunch, maybe you just kitchen sink it and you hope that that is a clearing event for the buy side. You can defend your numbers. You better have a lot of confidence if you're defending those numbers. Or you can end up in the middle, which is, hey, there's a lot of uncertainty. We're widening our range or something like that. And that actually may be the single worst way to do it because all you've done is prolong uncertainty about your own company's earnings profile. So earnings season can be really interesting in a couple of weeks.
So what's your base case? Option 1 or 2 or 3?
For the market?
For what these companies are going to do?
Scott Cronin on our research side thinks companies, particularly those that are exposed more to China, are going to start taking down numbers going into the earnings season. I think some of it is going to have to do with price action. I mean, if you're a company where your stock is already sold off a lot, you might as well just kind of kitchen sink it and try to get people involved. The issue, I think, and you saw this last week, is FedEx and Accenture as two examples of a few that those were companies early on, you would have said, are exposed to government spending, are exposed to global trade. Yet they still traded down, 6 to 8% on earnings. So what's priced? Not everything. And it's not even priced in the companies that would have been on your list to, kind of keep an eye on. So I think that's another reason why it's going to be a really tricky earnings season.
That's my sense when it comes to trade as well. Just how much of this are we really priced? And I think Europe rallying as hard as it has, China rallying as hard as it has over the past few months confused that picture even more.
Especially because you heard from the likes of H&M and all the fast retailers talking about their global sales coming down, that it is not just a U.S. phenomenon as much as people want to say it. So the growth was already slow, and we're seeing that today with the auto manufacturers in Germany taking a pretty big hit on the back of some of these tariff headlines.
We'll talk about the European picture in just a moment. Stuart Kaiser of Citi is going to be sticking with us. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. It's Danny Berger. Hey, Danny.
Hey, John. Just to recap the tariff action over the past 24 hours, President Donald Trump has signed a proclamation to implement a 25% tariff on auto imports. Collection on those levies begins April 3rd. The tariffs are expected to raise the price of foreign-made cars, but U.S.-made ones may see price increases if supplies and parts are also hit by levies. President Trump also suggested that more tariffs will be imposed on the EU and Canada if they work together to, quote, do economic harm to the U.S. The president on Truth Social saying that large-scale tariffs, far larger than currently planned, would be implemented in that scenario. Now, elsewhere, the latest update on the Signal Group chat that inadvertently included a journalist. Senate Armed Services Committee leaders are demanding an expedited Inspector General investigation. The panel's top Republican chairman, Roger Wicker, said that he would seek a secure briefing on the matter. Wicker believes that the information disclosed was classified. And that's your brief. John.
Danny, thank you. More from Danny later this hour. Up next on the program, Liberation Day comes early.
This is the beginning of Liberation Day in America. They've taken so much out of our country, friend and foe, and frankly, friend has been oftentimes much worse than foe.
We'll talk about some of those friends up next. We'll catch up with Bloomberg's Ollie Crook for The View from Europe, live from New York City. This is Bloomberg. So this is your snapshot of equity markets. Equity futures on the S&P 500 negative by 0.1%, on the Nasdaq down by 2%. If you want some single names, here they are: Stellantis, Ford and GM. Down in the pre-market, but not down a ton. We're down 6% on GM. Other names like Ford and Stellantis hanging in there. We're down 1% on Ford, down by close to 2% on Stellantis. Over in Germany, the DAX is down by 1 full percentage point. And beneath the surface, as you might expect, Lisa, it's names like VW, BMW, Mercedes that are trading softer.
They're going to get hardest hit, and they already have gotten hardest hit by some of the tariffs that have remained on from the initial round. Remember, there have already been tariffs announced that have been in place, particularly for some of the luxury providers. We keep going back to this. So far, the tariff announcements have not led to the price action outside of the United States that a lot of people had initially expected. Is this the beginning of a repricing of tariff risk, not just in the U.S., but globally?
And not in foreign exchange either. So beyond equities, maybe the intriguing developments in the bond market, yields starting to push higher again. on a 10-year getting closer to 440. I don't think that's too dramatic, but the direction of travel gets my attention. Likewise on a 30 at 4 basis points, pushing 475 this morning.
Yesterday, there was a 5-year Treasury auction that didn't go so well. It's not that these are dramatic moves, but what it shows is at a time that is risk-off, and yesterday was quite risk-off with a 3% downdraft for the Magnificent Seven, bonds are no longer a haven. And that tells you just the quandary that the Federal Reserve and investors are at a time where inflation seems to be ticking up and growth seems to be ticking down.
For anyone keeping track of supply, just for Lisa, $44 billion of 7-year notes coming out a little bit later at 1 p.m. Eastern Time.
Thanks, John.
Under surveillance this morning, Liberation Day comes early.
This is the beginning of Liberation Day in America. We're going to take back just some of the money that has been taken from us. We're going to charge countries for doing business in our country and taking our jobs, taking our wealth. They've taken so much out of our country, friend and foe, and frankly, friend has been oftentimes much worse than foe.
So here's the latest this morning. President Trump threatening large-scale tariffs if the European Union and Canada work together to cause economic harm to the United States. This as the EU readies countermeasures after the US slaps a 25% levy on autos. Joining us now, one of our friends, Bloomberg's Ollie Crook, joins us for more. Ollie, how are friends like Europe, like the French, like the Germans, like the individuals that lead the bureaucracy over at the European Union out of Brussels, what are they saying all about this?
Jonathan, I think it's interesting. I think the tack has somewhat changed here in Europe than it had a couple of weeks ago. I think potentially they're taking some of the advice that was given by Howard Lutnick, the Commerce Secretary of the United States, that was given on your show a couple of weeks ago, which is take a little bit more of a wait-and-see approach, be a little bit less aggressive in the sort of retaliation, and just sort of let things settle a little bit. We understand that the sort of delegation from the Europeans that were in Washington, D.C., they were met with a fairly frosty reception in terms of wanting to have any kind of real negotiation on tariffs before they basically become implemented on April the 2nd. But, you know, it's hard to sort of overstate the importance of these tariffs for basically the German economy. And at the end of the day, you know, in terms of retaliation, there is, of course, scope for the Europeans to retaliate. But what Trump is trying to target is a basically 250 billion euro trade deficit with the United States that Europe has. And at the end of the day, that pain will always be felt more by the Europeans. I think what really concerns the Europeans most is not just the balance of goods, the trade balance in terms of goods, is basically how expansive the Trump administration wants to be in terms of their economic aims. Are they going to take on digital taxation as well that the Europeans basically levy on American tech companies? Are they going to look at value-added tax? It is a sort of impressionistic view that the Trump administration is taking that it may not have enough clarity for the Europeans. And of course, if you want to just take a look at goods, that's maybe manageable. If you want to take it beyond that, that's going to be much more difficult for the Europeans.
Ollie, putting aside the VAT, the value-added tax, and some of the complications around that, is there a sense in Europe that leaders are willing to bring down some of their tariff rates in response to some of President Trump's threats and overall lower tariff rates, not necessarily amp them up?
Certainly. I think that we've had some reporting around this, and that basically looking at lowering tariffs on the auto sector is something that the Europeans are willing and open to do. And again, maybe it's a question of getting these tariffs in place and then finally sort of showing the olive branch that they're willing to do that. But they certainly have been receptive to some of these ideas. Of course, there is the idea of potentially boosting some of this, the LNG purchases. But again, just to sort of emphasize how terrible this is for European companies. This is not just a question of European cars going into the United States. You talk to BMW, according to them, in terms of the value of the cars that they actually produce in the United States and then export back to Europe, all of their SUVs, they claim to be the largest exporter of U.S.-made cars in terms of the actual value of these cars. So for these European companies to get caught in a sort of two-way tariff war, that's really the worst-case scenario, and that is what the Europeans are going to want to try to avoid.
Ollie, appreciate the update. Ollie Crook there. That's my favourite pub quiz question for people. Biggest auto exporter out of the United States. Huge plant for BMW in South Carolina.
And they're not alone. A lot of European auto manufacturers say their biggest market, both in production as well as in sales, is the United States, which leaves them in really quite a bind and is the reason why Europeans have been trying to negotiate because they understand what the consequences could be.
Maybe that's where we end up next week. I don't know. The range of possible outcomes is so wide, which is what makes it so hard right now for so many people trying to operate in this environment.
then what can we understand April 2nd to be? And this is what I keep coming back to. Is it going to be certainty or a launch point for negotiations? Because what Tyler Kendall was saying is that so far negotiations don't seem to be the desired outcome of the week ahead of that April 2nd Liberation Day.
You've all seen the performance gap in equities worldwide. The S&P 500 down so far in 2025 by close to 3%. The equity benchmark in Frankfurt, Germany, the DAX is up by more than 13%. Stuart Kaiser of Citi is back with us for more. Stu, how much of a threat are these headlines to that performance out of Europe?
I think they're a pretty big threat. I think early on in the year, most people would have attributed European outperformance to positioning and sentiment that was just completely washed out late last year into early this year. What's changed? One, you had good price momentum. Number two, look, the fiscal announcements out of Europe are potentially a real game changer, especially for real money investors in the U.S. But you could argue that Europe has sort of been unscathed by tariff announcements so far. So if you see any sort of, retreat on the fiscal alongside an increase in the tariffs, I think, that outperformance is going to be, called into question a little bit.
There have been a number of notes that I've been reading from strategists that say maybe the U.S. tariff hit is going to be greatest on the United States economy and U.S. companies. And that's the reason why this European outperformance can continue. You disagree with that, it sounds like. Do you think that the European hit will be greater and that even potentially the China hit is underappreciated?
The economic hit, I'm not 100% sure. On the price action part, I think, when you have whatever it is, 1,500 basis points of outperformance over a 3-month period, and now you have to price in, potential tariffs that could be disruptive to, economic policy and the markets, then, yeah, I think the price action can kind of narrow. In terms of, growth impact, if you ask the White House, what they will tell you is this is the biggest economy in the world, and we're net importers. So in theory, it hurts everybody else more than it hurts us. So that's the story from them. I don't think the Fed knows. I don't think the White House knows. I don't think anybody knows exactly how this very complex kind of range of tariffs is going to net out.
But this is the point, and it's like a psychological point that I've been hearing from an increasing number of guests, which is we have no clue. We have no way of modeling the United States right now, but we can model other areas of the world, and we can get a greater sense of policy reaction functions as well as where the impulse is going to be. So why not place a higher premium on those places than the United States that is the center of uncertainty? Yeah,
I think it's fair. If you think the quote-unquote end of UX exceptionalism is a big talking point. If you ask what have been the two things that have been most exceptional about the U.S. economy and U.S. equity markets, one's been fiscal spend. And the second has been we have large cap growth stocks that, frankly, just really don't exist in a lot of other parts of the world. It seems like fiscal in the U.S. is getting tighter. Fiscal in Europe is getting a little looser. Fiscal in China is getting a little looser. So you're kind of losing the fiscal advantage. And on the tech side, look, our tech stocks got quite expensive. You've had, the DeepSeek news that's kind of eroded some of the outlook there. So, I think there's a reasonable case to be made that the two biggest pillars of U.S. equity market exceptionalism are kind of under pressure. And I think people are, using that as a reason to embrace other regions.
I don't think you can overstate the importance of point two. Really undermining the AI build-out. And I can think of several headlines, not just the DeepSeek revelation, but also the Baba chairman coming out conveniently and saying, maybe we're overbuilding here. Microsoft, according to TD Cowen, abandoning data center projects as well, just chipping away at that story.
And we've heard other types of projects that have been abandoned at a time where, as you mentioned, Alibaba's chair came out and said, right now we can do a lot more with less, and they're going to be leaving some of these equipment areas for dead. It goes back to the question we've been asking. Is this a dot-com bubble? In the same kind of way that there are going to be people who are perceived as the winners who maybe won't be the ultimate victors of this particular tech upgrade.
I've been following Marko Kolanovic of JPMorgan, formerly of JPMorgan, out on LinkedIn, calling these conveniently timed pot shots from the Chinese regarding AI, the statement we had from the Baba chairman and what we saw from DeepSeek earlier this year.
It's easy to see how conspiracy ideas can happen because it does conveniently fit with a narrative, and it came at a pivotal moment that some of these, ideas that Chinese-made chips actually are just as good as U.S. ones, so maybe you don't want to just up the barriers.
It's led to a massive repricing of this equity market that we still haven't quite recovered from. Stuart, it's good to see you as always. Thank you, sir. Stuart Kaiser there of Citi. Up next on the programme, Maya MacGuinneas of the Committee for a Responsible Federal Budget. So do you think this looks like a market that's waking up to 25% auto tariffs? Equities down by 0.2%. Coming off the back of a big day of losses on the Nasdaq, we're down by 0.4%. Bob Elliott of Unlimited saying this: if the new administration follows through on its tariff ambitions, the policy mix and likely trade partner retaliation will drive the US economy into recession. Financial markets hardly reflect this reality, implicitly making a huge bet that Trump's policies are a bluff. Just a little bit softer this morning. Let's get you some movers, some morning movers with Danny Berger. Hey, Danny.
Hey, John, I got to look at the 3 worst pre-market stocks in the S&P 500. There's a flavor to it that will not surprise you. General Motors, the worst performer in the S&P pre-market, down 6.5% off the back of those auto tariffs. Reports suggest that about 50% of the cars they sell in the United States are made here. So only half, which might be why this one is getting hit harder than some of the other ones. It's not just the car makers themselves, it's also parts makers. This is an interesting one. PPG, they supply parts for a lot of different industry, and autos is one of them. The issue is that many of their plants are overseas. In fact, just yesterday, before the tariff announcement, they announced a new plant in Asia that would supply auto coating. So those shares down 1.8%. Finally, rounding out the worst 3 of the morning. This one is different. It is tech leading us lower this morning. AMD down 3.33%, getting a downgrade from Jefferies, who says that Nvidia has an advantage and that Intel is catching up. John.
Danny, thank you. Appreciate the update. More from Danny later this hour. On our radar this morning, if you are just joining us, welcome to the program. Our top story: President Donald Trump unveiling 25% tariffs on all auto imports and weighing more levies on Canada and the EU. The announcement coming ahead of Trump's Liberation Day on April 2nd.
As you said, it doesn't seem like markets are necessarily taking this seriously, given that Dan Ives of Wedbush said last hour that this would be like Armageddon for some of the auto manufacturers around the world when it comes to their profitability. What's interesting is the daylight between the market's reaction and the rhetoric, not only from policymakers in the United States, but also in Europe, with EU Trade Commissioner coming out and saying that U.S. tariffs are expected to remain in the realm of 20%. So they are really kind of hunkering down for the long term.
Speaking of daylight, we'll spend some more time talking about this in the next hour on this programme. The daylight that's emerging between Federal Reserve officials as well, I think it's really important. We heard from Chairman Powell last week, who gave the impression to a lot of market participants that they could look through this inflation-related bump, tariff-related inflation bump for 2025, look through it, hope that it comes back down in 26, 27, and gave the impression that that meant they could support any downside risk to growth materialising. Now, we all sat here and we said the same thing. Wait for the Fed speak. Wait for the Fed speak. Let's see how many people on the committee actually agree with him. I can count at least 3 at minimum who have already come out and put some real daylight between him and them.
The latest came yesterday from Alberto Musalem of St. Louis, where he said, I don't think so. It is premature to use the T word. He didn't say that specifically. But you had, of course, Raphael Bostic not even say the word transitory, saying, I'm not going to say it. So there clearly is a distancing of Fed officials from the Fed chair when it comes to how much they are willing to look through it. You also have Neil Kashkari saying that the #1 goal is to get inflation down, and they are not there yet. So you put these guys together, and what you get is a very unclear Fed reaction function. And frankly, it goes to the challenge of what is a Fed put in a stagflationary-like environment? How valid is it in supporting both risk assets as well as the economy?
And that's the huge market risk, I think, going forward from here. More economic data later this morning. About an hour from now, 8:30 Eastern Time, US jobless claims. Let's turn to another market risk. Microsoft is dropping new data center projects in the United States and Europe. TD Cowen analysts saying the company is pulling back because of an oversupply of computers that power AI operations, echoing what we heard from the Alibaba chairman earlier this week.
And this really goes to the heart of one of the concerns, and maybe what could be part of what's behind the sell-off that has disproportionately hit tech. Nvidia yesterday down more than 5%. Torsten Slok today coming out with an expectation of a slowdown that should be in the near term with semiconductor sales. It goes to the question that China has raised, which is, can you do more with less? And all of the infrastructure build out of data centers. Well, some of the infrastructure build out might make sense. This one might be overdone at a time where the biggest tech players in the U.S. have continued to say we can't spend enough on these areas.
Nvidia is still down by 24% from the height of this year. That's where the big dislocations have been. I think we've got to keep going back to that point. We talk a lot about tariffs, what it could mean for the economy, what it might mean for markets. If tariffs are so bad for the economy, then it should be terrible for European markets, should be terrible for markets in China. Something else, something extra has been happening this year, and it's around the AI story. And I think Microsoft, DeepSeek, it all speaks to the same thing.
Stuart Kaiser put it really well when he was saying there were two pillars to U.S. exceptionalism. One of them was that tech exceptionalism, that idea that you did have this outperformance of U.S. tech giants, and the other was fiscal expansion. The fiscal expansion has shifted overseas, and now that tech exceptionalism is getting challenged by some announcements, particularly over in China.
Let's talk about that fiscal expansion. The Congressional Budget Office warning that the government may not be able to pay its bills on time as soon as August if lawmakers fail to raise or suspend the debt limit. Mike MacGuinneas of the Committee for a Responsible Federal Budget writing lawmakers should raise the debt ceiling as soon as possible, and ideally alongside deficit reduction measures like the 2023 Fiscal Responsibility Act did. Mike joins us now for more. Welcome to the programme. Let's talk about some of the measures you'd like to see. What specifically would you like to see in the next few months?
Well, keep in mind the debt ceiling, which is something that we absolutely have to raise. We should have raised months ago. We should have raised in the beginning of January, not even used extraordinary measures. And it's something that is routinely used for a lot of drama that we need to stop when even discussion of default enters the national discussion. That is not how we should approach this. But the debt ceiling, which has been around for many, many years, sometimes is combined with bills that would make the debt worse. We saw that actually under the Trump administration last time. He increased the debt ceiling 3 times. Each time something was attached that increased spending. Sometimes there's a clean debt ceiling increase where it's just on its own. And then sometimes the debt ceiling has actually pulled along or been connected to measures that would improve the overall fiscal picture. That is what happened last time between the Biden administration and a Republican Congress that really pushed them into it, where they put in place spending caps that kept arguably saved over $1 trillion in the past 2 years. We're not sure where we're going to end up this year yet, by keeping discretionary growth capped. So you weren't allowed to kind of bust through those budgetary caps as we've done in the past. I think one of the ideas would be extend them. In that Fiscal Responsibility Act, they talked about having those go for another 4 or 5 years. I think that would be a great place to start. Ideally, they would actually put in specific policy savings. I think that's probably asking too much. But the debt ceiling is a reminder of how bad our fiscal situation is. The single thing it should not do is be combined with a plan that would make the debt worse, which is what lawmakers are currently talking about.
At the same time, Maya, what you're talking about is the resolution that aims to cut spending by $2 trillion, but increase spending by almost $5 trillion over the next decade, which would increase the deficit by $3 trillion. One argument is if you can have a pro-growth policy of deregulation and lower taxes, you can offset that with the denominator. You can basically grow the economy more than you do the deficit. What do you make of those arguments based on the proposals currently in Congress?
Yeah, let me just say that what I'm suggesting, that we have a debt ceiling increase that's combined with a big reduction in debt, we're not off to a great start. And so the budget reconciliation framework, which they're talking about attaching this to, is absolutely in the wrong direction. Before you look at growth, it would add about $2.8 trillion to our borrowing, and that's before you count interest payments. So the arguments, as you've said, has been, don't worry, we'll grow our way out of it. That's always the argument around tax cuts. Now, if you look at the range of realistic growth estimates that are out there, they are from slightly negative growth. The reason for that is that the additional borrowing is such a drag on the economy. It could actually be more than the growth that you get from the tax cuts. And another thing to keep in mind is that these tax cuts are not nearly as pro-growth, the specific ones we're talking about extending, as the ones that were made permanent in 2017. That's where most of the growth was in the corporate area and others. But the range of viable estimates is about slightly negative to about $700 billion. Meanwhile, the budget resolution is counting on the growth to be over $2.5 trillion. Lawmakers know that this is not a credible estimate. They then say, like, okay, we're counting all the other policies, so regulatory reform, other improvements. If you're looking at other policies, you also have to look at negative growth from tariffs and the disruption that's going on there. So the growth estimates, I'm sorry to say, aren't realistic at all. It's great to have pro-growth policies. Oftentimes, they can make a big difference. In this moment, they would make either a small difference or a negative difference. What we really need to do is own up to putting in place a budget, making some hard choices. Lawmakers right now are nervous to cut spending by that $2 trillion, but want to cut taxes by more. They should do the opposite. They're going to have to scale back the tax cuts and increase the spending reductions if they want to do something that would be fiscally beneficial.
Maya, can you give us any sense of green shoots of people who you're talking to who are looking to push through one of the more positive and debt-resolving types of bills? There are a number of fiscal hawks in the Republican committee, in the Republican caucus, and they've been pretty vocal. What gives you hope?
Well, I can't come to you with a whole lot of hope right now because the problem is that doing fiscal giveaways is really easy. When somebody says, what I'd like to do is scale back that tax cut, and somebody else says, well, I'd actually like to not tax income, wages, Social Security benefits, anything, that second person has a more appealing message. So a lot of credit goes to those who are saying we actually want to pull back on the borrowing. Interestingly, oftentimes I spend my time as a political independent working with the moderates who work together and compromise. That's usually where we see these efforts kind of getting some steam. In this case, it's really the most conservative members of the House and the Senate who are saying, I'm not comfortable with what we're doing. We've borrowed so much. Congressman Massey has said we don't have space for tax cuts. We need to be looking at spending cuts in many instances. Chip Roy is somebody who's been out there pushing, saying we need to have more spending reductions, pushing at his conference, bringing along a lot of people who believe that if the government's going to be spending $86 trillion over the budget window, they should be able to reduce spending by more than $2 trillion. And I'll just say those numbers again. They're going to spend $86 trillion. They're going to reduce spending by $2 trillion. And most lawmakers are saying, oh, that's too much. So you can see that sort of fiscal responsibility doesn't come easily. It is great to see some of the more conservative lawmakers, in this instance, pushing for those spending reductions. I would make the case, and again, we're politically independent, this isn't the time for tax cuts or spending increases. This is the time for a big debt deal because those fiscal warning lights are really, really blinking bright. We need to put in place a deal that would reduce our borrowing over the next budget window by $4, $5, $6, $7, even up to $10 trillion, and we still wouldn't get to the metric that we would like to be at ideally. I think a good place to start is let's try to get our deficits down to 3% of GDP, which is what Secretary Bessent has talked about, and then keep moving in the right direction from there.
There's a lot of work to do, that's for sure. Maya, appreciate your time. Maya MacGuinneas there, the Committee for a Responsible Federal Budget. Every single conversation you see with the Treasury Secretary, Scott Bessent, and he talks about it all the time. Don't have a tax problem, got a spending problem. And then every single time you hear from the President, what does he talk about? Talks about things like this. Last night, hardly been talked about, but it was in there. Have a listen to the briefing. He wants interest on car loans tax deductible if those cars are US made.
Yeah, it's everyone.
Something for everyone, right?
I mean, this whole idea of tax on tips, that everyone pays too much, but at the same time, there need to be cuts on certain kinds of spending, which makes it very difficult to offset. I just go to the economics of this. If you talk about fiscal retrenchment at the same time that you have potentially prices going up, it creates a real quandary for economists to try to understand how this math is going to add up by the end of the year.
Stocks are down by just 0.1% on the S&P this morning. With an update on stories elsewhere, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Thousands of Palestinians protested across the Gaza Strip against Hamas. They called on the group to give up control of Gaza and end its war with Israel. Protests against Hamas are rare, but not unprecedented. Israeli Prime Minister Netanyahu said the rally showed Hamas's political power has weakened. The Trump administration cut 10% of funding for the agency that oversees semiconductor export controls. The White House has been attempting to unilaterally block federal spending enacted by Congress. The funding cut, though, sparked concerns about the country's ability to stay ahead of China in the AI race. Now, elsewhere in tech, Apple is naming a global head of stores, streamlining management of its retail arm. Vanessa Triga will serve a new role as VP of Stores and Retail Operations globally. It's the second notable management change in Apple in recent days after shaking up its leadership in AI and Vision Pro departments. And that's your Bloomberg Brief. John.
Danny, thank you. When do the railings come down over the Apple store? You noticed that on Fifth Avenue? Got some pictures of it now. It's pretty ugly stuff.
Yeah.
You see that all around Manhattan all the time.
Yeah, no, I don't know. And honestly, this is something that they're going to have to grapple with. The stores, the manager of the stores. Is it beautiful?
The scaffolding. There's nothing beautiful about the scaffolding in New York City.
Yeah, sometimes they put sculptures on it around the corners, underneath the staircase. No, just kidding.
Let's see what Apple does about that. Up next on the program, the cuts keep coming.
I do fear that we've seen too much damage, and especially too much broad-based damage in the survey and the soft data in order to just dismiss it as a one-off.
Here comes another one. Venu Krishna of Barclays dropping his price target on the S&P 500. He joins us next. Equities right now negative by 0.1% on the S&P. We're down 0.2 on the Nasdaq 100, basically unchanged on the Russell in the face of 25% tariffs on autos. Under surveillance this morning, the cuts keep coming.
I do fear that we've seen too much damage, and especially too much broad-based damage in the survey and the soft data in order to just dismiss it as a one-off. This is not a call on the end of use exceptionalism. I think it is much more a call of perhaps sort of a near-term, really pretty bumpy ride in terms of hard data following the broad-based decline that we've seen in the soft and the survey data.
So that was HSBC and Max Kettner downgrading equities to underweight in the United States. Here's the latest elsewhere. Barclays slashing its S&P 500 price target in response to tariffs and weakening survey data. Barclays' Venu Krishna saying, our base case assumes that earnings take a hit as tariffs contribute to material slowing in US activity that nonetheless stops short of outright recession. Venu joins us now for more. Venu, good to see you.
Good to see you.
It's a change from 6,600 down to 5,900. Let's just start at the top. A change to the outlook for growth. How dramatic is that deceleration in growth going to be through 25?
I think quite substantial. So if you look at our economists, I think for the full year, we've cut our growth numbers to 1.5%. It was over 2% before, quite substantial. And I think Q4 over Q4, end of this year, they've taken it down to 0.7%. So I think the pullback in growth is quite substantial. At the same time, remember, there's been an uptick in inflation expectations as well. So that is a deadly combination, right? Slowing growth and inflation ticking up. And I think from our price target standpoint, we were always quantifying the impact on earnings, but it was never incorporated into our actual estimates because there was this uncertainty whether they're going to be literal or they're serious. Is it going to happen? Well, now there are no doubts, right? And here we are. And so we took the step of taking not just the first order effect, which is the earnings impact, but more importantly, the second order impact, which is that if inflation ticks up and growth also slows, that has a bigger implication. And that's why we've taken our earnings number down. But it's not a disaster. Earnings are still, with my reduced numbers, going to be up 6% year over year.
Yeah, it's hard to call you bearish. You're still looking for 5,900.
That's right.
Which is above where the market is right now. How did the client calls go yesterday? What were the responses like?
The first thing is everybody calling me a bear. I was surprised because it just so happened to be the first to cut, I guess, among other people. And I think it's likely to follow. But what I would say is that I have sensed this bearish sentiment on the rise, especially in the last few weeks. So I just came back from Europe. Without doubt, there's a negative sentiment, certainly in the US. Part of it is just shock at the scale of announcements and the change in policy stances and the speed of that. But also this notion that finally, surprisingly, that Trump could be a catalyst for Europe to finally get its act together from some structural reforms. There's a lot of uncertainty. But I also sensed a fair amount of skepticism about big tech. Remember, part of the US equity exceptionalism was the strength of the tech sector. It is still very strong, but maybe it's just to be expected because the markets are down, so everybody's feeling down. But I certainly sensed a lot of questioning about the productivity impact of AI. Is it really going to pan out? The kind of multiples it can sustain. Why we're using why 28 is, why 25, why not 22, why not 20? Sure. So I think, so these are the kind of questions that are coming up. And as you know, we started this year with tremendous amount of concentration. The US markets became 65-70% of global markets. And I think it came to a stage where investors are looking for a reason to diversify. And I think now we've provided them a few reasons to start thinking about it actively.
There's a lot to unpack. You said that initially you didn't know how seriously to take some of President Trump's proclamations. Now there are no doubts. And I assume that you're talking about the idea that he does want tariffs to be implemented.
Yeah.
Can you give us a sense of how you parse out the cost of tariffs in S&P multiples versus the cost of uncertainty that is likely to continue even though there is this clarity that there will be tariffs, we just don't know how big they'll be and on which sectors?
I'll address it in two parts. The first part is it's an iterative process. So you have to look at what combinations of tariffs we're talking about, and then we have a methodology of trying to translate that into direct earnings impact. So that's one. The second order effect, I say, is that in addition to that, now you start into our models estimating what happens if inflation goes up, what happens if growth slows down, manufacturing, sentiment, consumption. So all those inputs also start changing. So that's one. The second part of your question about uncertainty, I think uncertainty is first and foremost reflected in multiples. And see, the fastest derating we have seen in the US, at least in 22, in good part explains this uncertainty about the outlook for growth. And the way the market is expressing that, because numbers have not moved. So I've cut my numbers. I do expect others to start cutting their numbers as well. And if you look at the consensus earnings number for S&P, it's barely changed in 4 or 5 weeks. But the world has changed in the last 4 or 5 weeks. So I think that's going to happen. But the market is getting ready. Like I said, if you look at big tech, which has driven more than 50% of S&P returns in the last 2 years. The multiple was 34 last year in the summer. We started the year at 31. Now we're sitting at 25, 24. And so it's a pretty substantial derating, even if you take into account earnings growth for that group, which will settle in the 20% range.
How long does this uncertainty go on before you cut further, before you start thinking about your bear case of 4,400, or potentially on the flip side, could you get clarity that could make you go to your bull case of 6,700?
I think both are likely. And that's why we have those scenarios in place, right? Because I think I would like to believe, maybe it's the optimist in me, maybe I see life as glass half full, but there's a reason behind what they're trying to do. They're trying to level the playing field to some extent. And ultimately, the goal is to improve the competitiveness of the US economy and US corporate sector. If that is true, then I would expect that at some point over the next, call it 3 to 6 months, there'll be some clarity in terms of through negotiations where the dust will settle, right? And it's in everybody's interest, not just in the US interest. So I think that is the optimist part of it. And once that happens, we start moving beyond this phase of at least tariffs, and we start focusing on things like the tax cuts and deregulation, which, by the way, is what we were pricing for the last 6 months. And we kept saying that the market is being overly optimistic, just focusing on the positives, but overlooking the negatives. And guess what? The sequencing has changed. And that's what we're reckoning with.
Just quickly, do you think we're still overlooking the negatives? Are we really internalizing some of the tariff headlines that we're actually hearing in the last 24 hours?
Finally it is beginning to happen. But I can tell you that while the skepticism of investors has increased quite substantially in my discussions, but there is enough of a subset out there who really believe that all this is transitory, that all this is just going to move by and improve. And my point is, I hope that happens. But I don't see that happening in the next 6 months.
I certainly share that hope, sir. It's good to see you, as always. Venu Krishna there of Barclays on the equity market. Coming up next, Jim Caron of Morgan Stanley, Bloomberg's David Welch, Nela Richardson of ADP, and Amanda Lynam of BlackRock. The third hour of Bloomberg Surveillance just around the corner, and jobless claims are at 8:30 Eastern Time, 34 minutes away.
Given the kneecapping that we are going through from a policy standpoint, that raises the risk of a potential slowdown quite meaningfully.
We see a much more sort of broader-based slowdown.
What we've seen is already a divergence in terms of the consumer.
At worst, the consumer's mixed.
We see a decline in confidence across the board.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning to you all. The third hour of Bloomberg Surveillance starts right now, and what a difference a week makes. Only a week ago, investors were reflecting on a dovish performance from Chair Powell. 1 week later, and members of the FOMC are putting some daylight between him and them. From Fed Governor Kugler to Presidents Bostic and Mussolem, Fed officials are putting more weight on upside risk to inflation and pouring some cold water over the T word. That could have some implications for their ability to respond to any growing downside risk to economic growth. faith. This hour, we'll get another read on that with US jobless claims. Will the softer survey data begin to bleed into the so far resilient hard data?
And how much will the Fed look through some of the increase that we do see in inflation? I'm glad you started on this question of whether it truly is the mainstream of the Federal Reserve that is saying that inflation is going to be transitory from any kind of tariff hit, and show that there is a lot of daylight between different Fed members. When you take a look at the structure of this market, there is this idea that the U.S. economy is strong and that if it isn't, the Fed will rescue it. Right now, both pillars of that are being questioned, and that is the reason why some of this high-frequency hard data is going to become so important.
Let's pick up on these pillars of faith. One is the Fed's going to be there. Two is that these tariff headlines aren't that serious. Bob Elliott of Unlimited saying that financial markets hardly reflect the trade reality, implicitly making a huge bet that Trump's policies are a bluff. That's a big bet.
The big bull case coming into this year was that you had a Fed put and you had the Trump put, that essentially President Trump would not allow the market to fall too far in response to some of the more stringent policies around tariffs. What we're seeing is that neither seems to be engaged in any kind of predictable way. Even though earlier this week we were talking about the market gaining optimism that this president was taking a softer tone with tariffs, yesterday he is coming out and saying there's going to be a 25% across the board tariff on autos being imported into the United States, sent a bit of cold water over markets, but to your point, not nearly as much as you would think if people were actually taking this seriously.
Those headlines used to drive bond yields lower. Over the last few months, at least, that's been the trend since the highs of this year. Yields are starting to creep higher again. I think we've got to keep an eye on this. The curve's steeper again this morning. 10-year bond yields up by 3. 30-year bond yields up by 4.
Even yesterday, when the Magnificent Seven were down by some 3% on the day, you still didn't see bonds act as that catalyst of safety, this sort of sense of a haven trade. And it raises the question, is this the path ahead in a stagflationary-like environment? It goes to the question of how much of a Fed put can exist at a time when you have inflation as a challenge and growth as a challenge. And what we're seeing right now is the bond markets aren't sure what to do with it, but they aren't necessarily piling into long-duration bonds.
That is the question going into the economic data later this morning, 8:30 Eastern Time, 26 minutes away. Another read on US jobless claims. Mike McKee can break down that data for you. Coming up on the hour, Jim Caron of Morgan Stanley. As market volatility continues, we'll speak to Bloomberg's David Welch on President Trump's auto tariffs and Amanda Lynam of BlackRock reacting to the latest economic data. We begin this hour with stocks steadying after snapping a 3-day rally. Jim Caron of Morgan Stanley writing peak tariff uncertainty is now likely behind us. But this does not mean that markets will not be volatile. Uncertainty can't be priced. Volatility can. Jim joins us now for more. Jim, welcome to the program, sir. That first line's a big one. The peak uncertainty is now likely behind us. Are you able to say that before April 2nd?
I am, because, at this point, what we're seeing is we know there's a date, April 2nd. We know that tariffs are going to come that day. I think it's being called Liberation Day. So when we go back to February, we thought that tariffs, many in the markets, I should say, thought that tariffs were part of coercive foreign policy or just a bargaining chip or just really a bluff. But the reality is that it's really political ideology. And we're learning that, President Trump is very serious about this and that this is likely to continue. So once the market understands that this is actually coming through, that uncertainty starts to go away. But that doesn't mean that volatility goes away. Volatility will still certainly be there. The volatility is now good. But the difference between uncertainty and volatility is that volatility can be priced while uncertainty can't. When we went through that phase of adjusting from, with all this uncertainty coming into the markets, we saw a 10% drawdown in equities. It was the fastest drawdown that we've seen. I'd say it was the 6th fastest drawdown that we've seen in 75 years because it happened within 22 days. So this is what happens when the market hits a speed bump through uncertainty. But volatility is something that we're good at pricing and managing through.
Jim, it was a fast adjustment. I'm with you, but it's not a major adjustment. It's just one of those corrections that we typically see several times a year, which begs the question. I want to pick up on that word serious. The president is serious about this. Let's run with that. What gives you the impression the market is serious about this?
Well, number one, we did have that big adjustment. And you're right. It was a 10% drawdown. It's not necessarily a major drawdown. But I think what we're starting to see is from a sector perspective, we're starting to see the rotations, right? People are becoming a lot more diversified, a lot safer in terms of their holdings. They're owning higher quality, short duration, right? As you were pointing out earlier, longer term duration bonds are actually starting to creep higher in yield. That's not actually sufficient as a hedge at this point, because you do get some of the inflation uncertainty that goes along with tariffs. And I know we can debate whether tariffs are inflationary or not. I don't really think that they are, because it's just a one-off price increase. But that being said, that there's still an adjustment that's taking place there. But you're getting all of the natural signs. You're getting a steeper curve. You're getting a movement towards defensive sectors within equities. And you're starting to see investors now start to brace idiosyncratically across the markets. So, for example, if the auto tech sector may get hit, well, then that's a sector that gets underweighted. But there could be other sectors like in manufacturing or in materials, for example, that are actually could benefit from some of these tariffs that are actually doing better. So you're starting to see the market choose the winners and losers. So I do believe that the markets are starting to think that these tariffs are actually coming through.
There is this issue that you raised about uncertainty being unpriceable, but volatility being priceable. And yet it looks like we're not pricing in that much volatility or implied volatility going forward. If you take a look at the VIX, it is well below its recent peak in March and well below some of the highs during Volmageddon. Is that the place where you're hiding? You're saying, look, we're going to expect volatility to pick up even if there is some clarity.
Yeah, I think volatility price stays around here. So if I look at the VIX, it should stay somewhere around 20, plus or minus. Maybe I'd say actually inside of 20 on the VIX. Because effectively what starts to happen is the market starts to anticipate price changes in these assets based on these tariffs. Once you tell the market that there's a X% tariffs on autos, what the market analysts will start to do is they'll start to forecast earnings based on that within a range of probabilities, and that gives them their price estimates within a certain range. That means that essentially volatility should start to come down. It's the initial shock that's essentially being priced right now because we don't know the exact numbers. We also don't know how other countries are going to respond to what the U.S. does, and does this escalate and does this get worse? Where we become very concerned from an economics perspective is if this creeps into fundamentals and primarily if this seeps into the consumer. If we get a loss of consumption because the unemployment rate starts to really move higher, a big loss of confidence, then that can have a material feedback, negative feedback into the broader markets and into the economy. That's when I think the Fed gets concerned. But up until that happens, I don't think that that's going to be the case. And so far, the consumer has been holding up reasonably well. You can't get a recession unless the consumer really rolls over. What you end up getting is a mid-cycle slowdown. And that's what the markets are debating at this point.
Do you believe the idea that Neil Kashkari put out there, that the longer this uncertainty and, frankly, the hit to consumer sentiment goes on, that could potentially be a bigger liability for this U.S. economy than even the tariffs themselves? Is that what you're looking for?
Yeah, that's exactly right. I mean, there is a time element to this, right? We can't live in some form of limbo for an extended period of time without it affecting purchases and consumptions and things of that nature. So ultimately, these things do feed upon itself. Look, the first quarter is coming in probably weaker than what many people had thought. We've already made an adjustment, right? GDP for 2025 was expected to be about 2.2%. That was consensus. Now the consensus is closer to 1.7%. So there's been a 0.5% decline already in GDP expectations for this year. If this uncertainty and if this limbo continues, then it's a problem. But that's my point. My point is that after April 2nd, as long as we stick to that date, a lot of that uncertainty is now behind us. And now we just start to readjust the prices for the new tariff setup that we have going forward. That suspension, that limbo goes away. And now we just have to deal with pricing the volatility in the markets. And in a weird way, that's a silver lining. That's actually a positive.
Jim, I just wanted to finish on large cap tech. Just recalling one of your calls coming into 25 being neutral on large cap US tech. We've had some dislocation since then. The big powerhouse, the likes of Nvidia, down by more than 20% from the highs earlier on this year. Does that change your view on the situation?
It does broadly, right? So effectively, when we had the 10% drawdown, we went in our funds and we bought the S&P 500, cap weighted index, which ultimately puts us to a longer position in large cap tech, right? It adds exposure over there. But where we see the best opportunities is really in the European markets. We actually turned overweight on that in early February, and we continue to see that as a positive because it's a large cap value play that's essentially a good hedge against the large cap tech.
Europe, as you know, Jim, has already had a massive run so far year to date. Just looking at the numbers over in Europe, the banks are up by 26% year to date. Aren't the threats that we're discussing in the United States, aren't they applicable to the European Union as well, particularly for the growth story?
No, yeah, and they absolutely are. But what Europe is getting that the U.S. is not is a massive fiscal response, right? We're getting 500 billion euro in infrastructure, 400 in defense, and that's just a start. I think those numbers go a whole lot higher. And what we start to see is a reindustrialization of Europe, which needs industry, energy, and energy security. And effectively, these are things that have been missing from the European economies for the past couple of decades. And I think this is a catalyst, for Europe to actually start to move forward. You're absolutely right. Prices have moved up a lot. They've adjusted. But also remember, over the past 10 years, Europe has missed most of this rally that we've had in the U.S. Europe has a lot of catching up to do. So we feel as though that we're better placed in the large cap value space in European equities. We recognize prices are up, and we're happy that we captured some of that. But diversify the portfolio, hold on to those positions. I think they're going to bear fruit over the years ahead.
Hey, Jim, looking forward to being on that journey with you. Appreciate the time, as always, this morning. Thank you, sir. Jim Caron there of Morgan Stanley. Lisa was reflecting on some of the comments we had from earlier this morning from Stuart Kaiser of Citi, who pointed out the two reasons behind the US equity market exceptionalism of the last several years. One was AI and the other was fiscal. And this story has changed, almost reversed, so quickly that all of a sudden the fiscal story has shifted abroad. It's gone over to Europe. And in the United States, maybe the vibe has shifted in the other direction, which has been a surprise for many of you coming into 2025. A story right now that's getting a ton of buzz, and Danny's going to break it down for you in some detail in just a moment. Drops from the Wall Street Journal just minutes ago, Lisa. RFK Jr. planning 10,000 job cuts in a major restructuring of the health department.
And that's in addition to the 10,000 of employees who left the voluntary buyouts. They took those previously. All of this would amount to the department shedding about 1/4 of its workforce, shrinking to 62,000 federal health workers. So you see this kind of effort and these job cuts percolating out. And this isn't just in Washington, D.C. This would be in offices around the country.
These could have big ripple effects across this country and this economy as well. Just a reminder, we get another read on the labour market in about 20 minutes time, 17 minutes time. US jobless claims are just around the corner. Let's give an update on that story and more with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. I'll get to that breaking news in just a moment. But starting on tariffs, President Donald Trump has signed a proclamation to implement a 25% tariff on auto imports. Collection on those levies begin April 3rd. The tariffs are expected to raise prices of foreign-made cars, but U.S.-made ones may also see price increases if supplies and parts are also hit by levies. President Trump also suggested that more tariffs would be imposed on the EU and Canada if they work together to, quote, do economic harm to the U.S. The president on Truth Social said large-scale tariffs, far larger than currently planned, would be implemented in that scenario. Now to the breaking news. Health and Human Services Secretary RFK Jr. is set to significantly slash the department's workforce. The Wall Street Journal reporting that Kennedy is looking to cut 10,000 full-time employees across departments that handle disease outbreaks, drug approval, and more. Kennedy is expected to make that announcement at some time today. And that's your brief, John.
Danny, thank you. Lisa, this is the rebalancing of the economy that Secretary Besson is talking about all the time, away from the government, back to the private sector, and acknowledging that along the way there could be some pain.
Especially given how much of the economic growth that we've seen has stemmed from the expansion of the government's purse strings, the sort of exchange of company and consumer debt into the hands of the government. Question is, will this just be focused in Washington, D.C., or how much more broadly this will be felt? This job cut proposal also includes the health department losing 5 of its 10 regional offices. So these job cuts are coming not just in Washington, D.C., the nation's capital, but around the nation.
It's the detox the Treasury Secretary has reflected on a few times now. Up next on the programme, the morning calls, plus Bloomberg's David Welch on President Trump's auto tariffs, 25%, and this equity market is doing okay. On the S&P, we're down just 0.1%. That conversation up next. Equities right now on the S&P 500 negative by 0.1%. On the Nasdaq 100 down by 0.25%. The index level just a little bit softer at the moment off the back of these tariff headlines. But beneath the headlines, beneath the index, check out the auto sector. Look at these moves now. Stellantis, GM, Ford, Bramo. Makes sense of this. Turning positive on the session by 1.2%.
Okay, the only thing that I can find is Bank of America is saying that Ford actually is a relative beneficiary from Trump's tariffs, saying that they might be relatively less affected and may even benefit as it only imports a few models, which account for a modest 20% of its total volumes. What this indicates to me is how much people are trying to say, yeah, but to look below the 25% and say, okay, what's actually going to stick, and then where can we find opportunities?
Stellantis is only down by 1.3%. GM is lower by something like 6%. But these aren't the kind of moves you'd expect if we were really taking this story seriously. So are we fully internalizing the drama here? I've lost count of the amount of cuts we've seen to economic growth and price targets on the street on the S&P 500. Cuts to growth outlooks from just about everybody, including JPMorgan, Morgan Stanley and Goldman. We've had equity downgrades from Citi and HSBC, price target cuts from Yardeni, Costin, Calvacina, heard from Barclays a little bit earlier this morning. That's got to be the question, Lisa. What is this? Have we fully internalized the story already, fully discounted it, or do we just not believe it?
People seem to say that we are pricing in about a 10% all-in tariff rate in the current equity valuations. That said, we were talking with Dan Ives of Wedbush, and he said if this goes through as proposed, it would be Armageddon for auto stocks. And he doesn't see how President Trump does this, which is the reason why he is dismissing this is permanent 100% as fact and simply part of a negotiation.
The S&P down by 0.1%. The open about 1 hour and 10 minutes away. Let's get to your morning calls. First up, HSBC slashing its price target on Tesla to 130. Expecting shares could fall 50% on brand erosion. Your second call from JPMorgan cutting its price target on Ferrari to 460, pointing to a volatile policy backdrop. That stock is down by 1.9%. And finally, JP also lowering its price target on GM to 53, citing, quote, material earnings risk from draconian auto tariffs. Let's stick with those autos. Shares lower as global automakers gear up for 25% tariffs on car imports to the United States. Bloomberg's David Welch joins us now from Detroit for more. David, welcome to the program. Yes, we are seeing some weakness in some stocks, but we're not seeing the kind of moves you would have guessed if we'd got a 25% auto tariff from the President of the United States. David, what gives?
I think some of it, some of the price impact on the stocks might be baked in a bit. And I think, per what Dan Ives said, there may also be a sense from investors that this won't be permanent. This is a bargaining tactic. Trump says a lot of things to get leverage in talks, and it doesn't come to pass. However, he has said that he wants to realign the auto sector and, well, actually industrial goods generally in the U.S. and get more things made here, fewer things imported. And if that's a real agenda, and this is a long-lasting set of tariffs, it will realign things, and there are some serious impacts. I would say Toyota and General Motors and close third Stellantis would be hit the hardest by this. European automakers will as well, but a lot of them are luxury makers, BMW, Mercedes. They do have big plants here, but also it's easier to bury the cost of tariffs in luxury vehicle prices, and people want that specific vehicle. We're talking with General Motors, this is a really tough one. You're talking about pickup trucks, one of their core vehicles. They have a plant in Mexico, one in Canada. Now, because those vehicles are USMCA compliant, only the non-US content is hit with a tariff. So you have a $50,000 Chevy pickup truck, let's say half the content is US and half isn't. I'm just making that up, but sure. Then half the value of that truck would be tariffed at 25%. That's a lot of money to add onto the sticker price. The worst part is Chevy's most affordable vehicles, Chevy Trax, Chevy Trailblazer. These are small SUVs sold to entry-level buyers. Those are made in Korea. There's no USMCA exemption there. That's a 25% hit, and that's these are the lowest income buyers typically. Chevy Equinox, that's GM's family car basically. Crossover SUVs are the family car these days. Those are made in Mexico. USMCA compliant, sure, but you're still adding tariffs onto something that has thin margins and sells at a pretty low price to buyers who are not the richest customers GM has. So those are the impacts there, and GM's got quite a bit of it because of the imports they have. Toyota, half of their sales are imported from Japan. That's a big hit for them. Actually, I don't know, they're not all from Japan, but they bring in some from Canada and other places. But half of their U.S. sales are imported, and they're going to get hit to some degree, if not full 25%. That's a heavy hit for them. Honda makes a lot of vehicles in the U.S., actually. They might end up doing okay. And Ford makes vehicles in Mexico, but it's a small number. It's the Mach-E electric vehicle. It's the Bronco Sport. The one that would hit them the most is Maverick small pickup truck. That's an entry-level vehicle as well. So you could say, the entry-level buyers might get hit the most from this.
David, this is going to take a while to figure out. I get that. In a moment, we'll have a conversation on the broader economy. I just wanted to understand from your standpoint, what happens from next week? Do prices go up overnight? How much do they have already in terms of inventory levels, given that it was difficult to build them out through the pandemic? Where are we on all of that?
There was some inventory building. I'm surprised by how much we didn't see. So, look, you will see some prices go up, but what's going to happen over the next week is car companies, their suppliers, everybody in that supply chain is going to be doing a lot of negotiating, bickering, if you will, trying to shift costs here and there. Car companies might say, hey, look, you're going to have to help bear some of this cost, otherwise we're going to stop shipping this model to the U.S., and that's lower production. You may see lower production, and but I do think there will be a period of calm here because the automakers are going to kind of sit back, see if these are really permanent. And they'll probably, in the near term, eat the costs and just kind of see what the Trump administration does, what happens in talks with these various countries, what happens with retaliation. And it actually could take months for all of that to play out.
David, appreciate the update. From Detroit, David Welch there on the latest. Speaking of that calm, the automakers being calm, I have to say, to some extent, investors are as well, based on the price action so far. Typically, we would sell, ask questions later. And right now, things are pretty stable, given the headlines we've seen and the drama that came out of the Oval yesterday.
And especially given some of the rhetoric coming out of certain Wall Street banks and analysts, this from JPMorgan saying that if this does go into effect on all imported vehicles, it is unequivocally negative for auto retail in the entirety, both the near and medium term, talking about 50% of vehicles sold in the U.S. being imported. It would probably result in an increase in cost per car of $4,000 to $5,300.
Calling the tariffs draconian over at JPMorgan. Up next on the programme, we'll get you some economic data, jobless claims just around the corner, some reaction from Nela Richardson of ADP and Amanda Lynam of BlackRock, both here to react. From New York, this is Bloomberg. The difference between soft data and hard data, sentiment, feelings, and what you're actually doing. Action. Jobless claims just around the corner. Some hard data for you, seconds away. Equity futures into that, negative 0.1%. On the Nasdaq, we're down by 0.3%. In the bond market, yields creeping higher all morning. On a 10-year and 30-year, up by 2 to 3 basis points across the curve on 10s to just short of 440, on 30s to around 474. With that economic data, here's Mike McKee. Good morning, Mike.
Good morning, John. Well, we're not feeling bad about jobless claims this morning. They come in just 1,000 higher than they were initially reported last week at 224,000. Looking at the data, it's decreased because they revise up to 225. So at this point, we're pretty stable in jobless claims. Continuing claims, 1,856,000. That's down from 1,892. And then in terms of the federal workers, let's see here, we have 9,135, so a jump of about 3,000 from last week. Continuing, I'm sorry, that's the continuing claims. New claims, only 821. So I read that wrong. 821, that we are not seeing the effects of the Doge cuts yet in jobless claims. Wholesale, advanced trade, negative 147.9 billion. That's down from a negative 155 billion, which had been a record. Now, this is just goods. Doesn't include services. Next week, we'll get the full trade report, but it does show there's still a big pull forward, it seems, in goods ordered by companies to get ahead of tariffs. And finally, GDP gets pushed up by a tick, 2.4%. The first reading was 2.6, the second 2.3. So they split the difference in there. Personal consumption up 4%. That's down from 4.2% in the revision last month. So all in all, an economy that is still about the same as it has been.
So, Mike, this is the challenge we've all got when we look at this economy right now. If you look at consumer sentiment from the Conference Board, it tells you things haven't been this bad for 4 years. Things are even worse now than they were when inflation was approaching double digits and the Federal Reserve was throwing out 50 basis points, 75 basis point interest rate hikes every other meeting. Mike, that's difficult to believe when jobless claims are running at 224. How do you explain the difference between what the surveys are telling us and what we're seeing in the actual hard data?
Well, when you look at those confidence surveys, both from the Conference Board and from the University of Michigan, what's really moved is future expectations. So people are looking at the tariff headlines and thinking things are going to be bad 6 months from now, but they're not bad yet. And companies don't seem to be letting people go. Everybody seems to be waiting to see if the hard data show that people are pulling back. And we get more of that tomorrow with the PCE spending report. So that'll get a lot of attention as well. But it's sort of like a dam holding back water. The water level's rising behind the dam, but it hasn't broken through.
And the water levels keep rising. Mike McKee, thank you. And might rise again tomorrow when we get you, Mitch, consumer confidence. Nela Richardson of ADP is with us around the table. Nela, good morning to you.
Good morning.
I'm going to throw that question your way. I'm sure you knew it was coming anyway. This difference between the survey data and the hard data is quite remarkable. What do you make of it?
You know, we've had a downbeat consumer for 2 years. It's not any different. I mean, we can talk about degrees, and we can talk about drivers. They've shifted now to tariffs, but the consumer has been downbeat, but still spending. And the reason is because they've been supported by a very resilient, strong labor market. That is the key differentiator. Now, when we expect sentiment to match action is if we see a degradation in the labor market. And those initial jobless claims aren't showing that at all. They're showing that initial jobless claims are still at historic lows, not even averages, lows. So we can feel as bad as we want as we're shopping in the mall, but we're still shopping in the mall.
Which raises the point of whether we should pay more attention to CFO and CEO surveys than maybe consumer surveys, if they're the ones that are going to engage in the capital expenditures and other plans that either will result in hiring or firing. I go to the CFO survey by Duke, as well as the Dallas Fed survey that John cited, where one person said, "I have never felt more uncertain about our business in my entire 40-plus year career." Is this a sentiment survey that has more correlation to the labor market than, say, consumers?
I think so. You had a guest on previously, a few minutes ago, who was talking about how you can price volatility, but you can't price uncertainty. I'm going to go a step further on that point. You can plan for risk, but you can't plan for uncertainty. You can't plan in terms of headcount and capital investment because there's no models that you can build around it. So when you go to hiring, it's hard to plan for something that you really don't have any scenarios around. And I think it's a big jump to go from uncertainty to layoffs. That's not how companies do their headcount. Uncertainty shows up first in hiring freezes. It may show up in a pullback in hours worked. It may show up in a lowering of bonuses, and we didn't see that on Wall Street, but you might see that in the real economy. Right. But there are all these different levels to hiring hesitancy before you get the actual layoff. So a lot to percolate before we actually see it happening in the real data.
Which is the reason why this Duke University CFO survey, even though optimism around respondents fell to about the lowest in the year, you're not necessarily seeing it in the initial jobless claims. Have we reached the point at which companies are no longer scarred from the pandemic and remember the time when they couldn't get workers fast enough back into their doors after laying off people in big numbers? Do you think that that is still a valid argument for why people are going to be more hesitant to laying people off this time around?
There's a real tension here, and I think this is where we might see some idiosyncratic behavior among companies. Remember, we also had a great resignation during that time, so a lot of new employees walked through the door, and they're staying longer. So companies hired thinking there's going to be a lot of turnover. They haven't seen a lot of turnover. So we're in the stasis, but employees, noting the sentiment and the vibe, are staying at their jobs longer than expected. So how do firms actually deal with that kind of new data point, that their turnover rates are very, very low? That's to be considered among this really broad, uncertain fog. So really it's hiring through fog. Your workers are staying longer than you expected. You don't know what exactly your price climate is going to be, and you're trying to figure out and navigate all these changes. And so for right now, all that hesitance, all that uncertainty means that firms are just being hesitant in their hiring. They're not making big moves right now.
So, Nela, next week and the start of April is going to be a big week for economic data, for another read on the jobs market. So we get the JOLTS report. Then the day after, we get your report, the ADP employment change. 2 days later, we get payrolls. The following Friday, next Friday, a week tomorrow. What's the guide from your standpoint, your perspective? Help our audience navigate that data. What are you looking for?
We saw a big pop in manufacturing, actually, in the February report, both in the ADP data and the BLS data, and it was really driven by some increase. There is one place where sentiment rose, and that was in manufacturing in January. The unfortunate part about it is it's soured by February. So this could just be a one-time pop, or maybe this is like a consistent pattern, because manufacturing has been in the lows for a really long time. And if you take that back to the news of the day, auto tariffs. Autos not only contribute 3% to GDP, they actually drive the manufacturing of the other 11%. So if these tariffs are just absorbed and auto moves on, that's great for manufacturing as a whole. But if it's bumpy for the auto industry, it's bumpy for manufacturing in total.
Markets will move really quickly, and they have done over the past month or so. These kind of trends, it takes time for them to take effect, start to emerge in the labour market, and it could be months before we really see this play out with any real strength or weakness, for that matter.
Even in 2008, when you saw the Great Depression, take two, where you saw this incredible downdraft in the economy as well as bank failures, you didn't see peak unemployment, I believe, until 2010, right? Or was it 2009? But it took a long time before.
2009.
Yeah, 2009, but before it really peaked, which raises the question, is that still a leading indicator? Or is that going to be the last pillar to potentially fall?
Equities at the moment not falling, just about unchanged on the S&P 500. A special thanks to Nela, as always. Nela, good to see you. Lots of economic data next week, including the ADP employment change. Michael McKee's back with us for a little bit more. Mike, I want to talk to you about the Fed officials. Lisa and I were reflecting on this to start the hour. The Fed chair gave a very dovish performance in the mind of many investors in the news conference last week. We've heard from several officials that have just seemed to pour some freezing cold water on that T word. Transitory. What have you made of it all?
Well, I think basically they're all singing from the same hymn book. It's just a slightly different tune. Jay Powell said the same thing that Raphael Bostic told us on Monday, and basically sort of the same thing that Alberto Musalem was saying yesterday, that if we see deterioration, they will cut rates. If they see the inflation rate go up or there be a problem, then they would have to consider leaving rates longer or raising rates. And the problem is here, they don't know what's going to happen. So they're making, we on Wall Street are making very fine distinctions in what they're saying, but it's sort of the same message. Now, Musalem was much more direct in saying he worries about second-round inflationary effects from tariffs. But I don't think that there's a real division on the Fed about any of this. It's just that they're all at sea, so they're falling back on their job description rather than any particular prescription for what's going to happen.
Are you suggesting I'm trying to find division where there isn't any, Mike?
You're always the guy holding the coats when the two sides fight. I think that a lot of people are, it's just habit. Who's dovish, who's hawkish. I don't think if inflation starts to rise, I don't think you'd have any real dissents on the Fed at this point in taking further action.
Interesting. Mike McKee on the latest. Mike, thank you. Appreciate it. Thank you, sir. Lisa, what do you make of that?
There was a clear rallying cry on Wall Street. I'll just go to the market reaction. There was a clear rallying cry on Wall Street last week when Fed Chair Jay Powell came out and said that it is likely to be transitory. And someone repeated that word, and he repeated it again, even though it has a lot of hair on it, and talked about how it was likely that any kind of tariff effect would be short-lived. We have heard rhetoric that flies in the face of that pretty dramatically over the past couple of days, in particular by Alberto Mussolem, but also even Neel Kashkari talking about how the job isn't done. They don't have the same kind of confidence that inflation is getting down to 2%. So all of this, you put it together. And the point is, maybe the markets got ahead of themselves and thought that the Fed put was more engaged or not. But the sentiment has clearly shifted over the past week about exactly when the Fed would act and what that leverage really would be.
The tone and delivery matters, and the tone and delivery of the Fed speak over the last week, I think, has been markedly different to what we heard at the news conference a week ago.
It seems like the market is kind of sensing that out.
But it's open to interpretation.
But it's all open. Look, this is an imperfect science, and Mike is correct saying they're all in a dark room with a blindfold bumping into the walls.
And each other, apparently. Amanda Lynam of BlackRock with us now for more. Not a picture Amanda wants to see. Amanda, good morning. It's good to see you.
Thank you for having me.
What do you make of this difference between Chairman Powell and what you've heard from the officials over the last week? Is there some daylight between the two groups?
Well, I think it absolutely underscores the uncertainty. And going back to the point you were raising, the disconnect between the sentiment data and the hard data, I think part of it is the growth backdrop is much weaker now versus a few years ago. Real wages for consumers have declined, so their purchasing power has declined. The labor market is not as tight. And so I think that's actually what's manifesting, because I agree with you. One of the questions we get is, how could consumer sentiment be so bad? But actually, if you look at the labor market, purchasing power, I think it helps explain that. We see room for the hard data to catch down to the softer sentiment data, and we also see room for credit fundamentals to catch down to what has been a pretty negative revision or earnings estimate and company guidance. And I think it underscores the uncertainty. I don't think we have conviction on the path of policy in many respects, and so it makes it difficult to have conviction on inflation.
It seemed like last week, just to build on the point that John was making, it seemed like last week people heard Fed Chair Jay Powell essentially lean into the idea that they would prioritize any kind of downshifting growth over any increase in inflation. Do you think that that was an incorrect interpretation, or do you think that maybe that is his opinion and isn't the mainstream of the Federal Reserve?
I think during the press conference, it was couched with a lot of uncertainty. He did say, we're not quite sure if we'll be able to look through this. I agree with you. What was actually striking to me was Atlanta Fed President Raphael Bostic's interview with Mike earlier this week, where he talked about companies are actually planning on raising prices, and they're not expecting a hit to their sales volumes. And so it remains to be seen how the consumers will deal with that. But I think there are some inflationary pressures in the system, and I think a lot of Fed officials are telling you that they want to watch that very closely.
There's a larger point here, and we keep coming back to it, this idea of, have people had the idea of a Fed put that is now obsolete in a very different environment? The idea that if growth slows, the Fed can engage with some sort of stimulus by cutting rates. Is that fundamentally being challenged at a time where people are raising their inflation forecasts and lowering their growth forecasts?
I think the reaction function is constrained, is the way that I would phrase it. And I think they really do need to see deterioration in labor demand and the labor market before they actually further normalize policy, never mind ease policy. And so I think that's really the delicate balance that we're in right now, is that they are attuned to downside risks and growth, but I think they are hesitant. And I think even President Bostic said this. They didn't actually want to get ahead of it until the growth data actually materialized. That's the risk. And again, I think it's hard to discount the wide range of sentiment data that has come through. You had referenced the CEO and CFO surveys. The real risk is that if the C-suite starts behaving like there is going to be a significant downturn in growth, whether that's CapEx or investment, hiring, and almost becomes a self-fulfilling prophecy that the sentiment is so bad, so it paralyzes folks, whether those are consumers or corporates, and you actually have the material growth slowdown that we're hoping to avoid.
And then these Thursday mornings start to sound a lot different when we get jobless claims at 8:30 Eastern time. You said catch down. Let's build on the catch down, not just the hard data down to soft, but also the catch down in credit. as well. High yield spreads are still pretty tight, around 300 basis points. What degree of catch down are you and the team looking for?
So I agree with you. Credit valuations have not kept track with either the deterioration in sentiment in the equity market or just more broadly. So we think there's some room to widen there. The median is 460, right? So should we argue that there's more uncertainty in this current environment relative to the median of the post-financial crisis era? I think absolutely. Now, to be clear, there are some important counteracting forces that would keep that widening from being that extreme. The technicals are still incredibly strong. Most investors that we talk to are waiting to buy the dip and buy the widening. So to me, that says that most widening episodes may be short-lived. The new issue technicals are really favorable. Not a lot of new money. Most of it's refinancing. So there's some really important nuanced technical factors that will kind of act as a bit of a mitigating factor on widening. But we are absolutely expecting for some widening to come through.
Do those technical factors reduce the volume of the canary in the coal mine?
Well, I think market structure shifts do alongside those technical factors. And so typically corporate credit is a very growth sensitive asset class, and it should respond more swiftly to growth deterioration. We've had the growth of the private credit market, which on net we think is a positive for funding access because private credit has shown an ability and willingness to step in periods of market volatility. Importantly, something that's not discussed a lot, for example, the CLO market, very rating sensitive buyer, and it comprises almost 2/3 of purchases in the leveraged loan market. They can't hold a lot of triple Cs, and sometimes they shy away from B- even when the growth is choppy. So there are technical reasons like that sometimes prevent the syndicated market from operating as you would expect. That opens a door for areas like private credit to step in. It doesn't mean that that's bad risk. It just means that the technicals are not cooperating. And so that is new this cycle.
To build on what John's asking, are we looking in the canary in the wrong place? That the idea of high yield spreads traditionally as a leading indicator for risk assets has no longer the same kind of telltale effect, and that really it's private markets that we need to be looking at. Are we seeing signs of stress in private markets in any capacity?
You aren't really seeing a large degree of stress in private markets either. I think what that means is that the nature of the shock is not emanating from the credit market, whether that's liquid or private credit. It's actually emanating from consumer spending, policy uncertainty in some regards. And so I think that's probably the difference in this environment, is that if the nature were coming from the credit market, if it were over-levered companies that were doing shareholder-friendly actions, doing M&A and levering themselves up, perhaps that would be the early signal from the credit market. But that's actually not what's happening here. It's the nature of the stress is not coming from the corporate market. It's coming from uncertainty and a potential slowdown in consumer spending.
Do you get the sense this market won't really take these headlines seriously until we see it in the hard data?
I think we are seeing signs of it being taken seriously. So, for example, we're seeing certain sectors underperform, even though index level credit spreads are tight, as you noted. We are seeing some underperformance. I would say on the margin, investors realize that the administration is focused on raising revenue. And so tariffs are a means to do that. And so, again, we don't dismiss the sentiment data, nor the potential for significant policy shifts. Our colleagues in the BlackRock Investment Institute expect an average effective tariff rate of 10%. Which is well above where we are now.
Amanda, appreciate your time as always. It's good to see you. Fantastic. Amanda Lynam there of BlackRock with an update on news elsewhere this morning. Let's get your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. Discord could launch an IPO as early as this year. Sources tell us that the communication platform is currently working with Goldman Sachs and JPMorgan on plans. Timing and partners could still change, though. Discord was last valued at $14.7 billion in 2021. The Congressional Budget Office is warning that the federal government could be facing a payment default risk as soon as August if lawmakers fail to raise or suspend the debt limit. The CBO added if budget needs are higher than anticipated, the Treasury's resources could run out by May or June. Elsewhere, Japanese Prime Minister Ishiba won't rule out taking countermeasures against the Trump administration's car import tariff. Japan previously had been making pleas for an exemption and promised to buy more LNG from the U.S. Last year, cars and car parts accounted for a little over 1/3 of Japan's exports to the U.S. That's your Bloomberg brief. John.
Hey, Danny, thank you. Lots of tariff drama. Not much drama in this market so far. Things are pretty calm. Let's see if this stays this way. Things can change. Equities at the moment on the S&P down by 0.1%. Up next on the programme, we'll head down to Washington and set you up for the day ahead. From New York, this is Bloomberg. The opening ballot is 37 minutes away. The president comes out, slaps 25% tariffs on autos, and this happens. Not much happens. Equities on the S&P 500 down by 1/10%. On the Nasdaq, down by 1/4. On some of the auto stocks, the big three in Detroit that we often talk about. GM, Ford, Stellantis, these aren't major moves lower, with the exception maybe of GM, which is down 7%. Ford was positive only 30 minutes ago. So I'll give you a choice out of three. Here are the three choices, Bramo. It won't have much of an impact. It was already well priced, or nobody is taking it seriously. 1, 2, or 3.
Well, Dan Ives said 3. I'm going to put it in someone else's mouth. Dan Ives was saying 3, that this isn't being priced and it would be absolutely catastrophic for the industry. Other people are trying to see green linings and the idea that silver linings, that Ford might actually be the least worst beneficiary. And that's the reason why this, honestly, go figure. But I would argue that people still don't know exactly what to price it.
Green linings work too, cash money.
I'm really on a roll today. It's really good.
Your next week looks like this.
Off
2
the
p.m.
envelope.
Eastern Time. President Trump signing another round of executive orders tomorrow. Core PCE and UMich consumer sentiment. Looking ahead to next week, lots of economic data on the jobs front. Jobs and ISM manufacturing. Wednesday, ADP. Thursday, claims. Friday, payrolls, and a lot of data in between. With us down in Washington, outside the White House for a final word, is Bloomberg's Tyler Kendall. Tyler, what are you looking for through the rest of today?
Yeah, hey, John. Well, some still big questions about those auto tariffs, including that the administration says it's looking into how to tariff auto parts that cross the border multiple times. We know that could have a pretty big impact when it comes to consumer prices for those domestic-made vehicles. You laid out all the data that we're expecting tomorrow, that University of Michigan survey, known to be a little bit more sensitive to politics. We'll have to see how this White House responds to that. After yesterday, President Trump did say the data that he's watching is that he wants to see the job numbers, job creations, going on to reiterate that he claims he's not watching the markets, but did add that he thinks that they're going to like what he does next week.
Tyler, thank you. Looking forward to your coverage. Appreciate it. Tyler Kendall in front of the White House down in Washington. Tomorrow, we pick up the conversation with Victoria Fernandez of Crossmark, Michael Zezas of Morgan Stanley, Kevin Gordon of Charles Schwab, and the former St. Louis Fed President Jim Bullard, and a whole lot more. Annmarie will be back in the seat. Looking forward to that. For now, though, big tariff headlines, minor market moves. Live from New York, this was Bloomberg Surveillance.
Welcome back to another special Miami Open update for Bloomberg TV and radio from Tennis Channel. Alex Ayala continued her dream run with a statement straight sets win over former world number 1 Iga Swiatek to reach the semi-finals. Ayala has now beaten 3 major champions on her way to the semis. And don't forget, you can watch all the action live daily on Tennis Channel.